Okay, good morning. Good morning, good morning. Sorry to interrupt that jazzy music, getting us going. So I have some good news and some bad news. Welcome to day 2 of our policy conference. We've got another fantastic day of content lined up. So I've got good news and bad news. The good news is Sheila Bair's in the building, getting mic'd up as we speak. So we are about to have a really wonderful kickoff session that could not be timelier. Bad news. Okay, the bad news is on the fundraising side. So I have a foundation update. We have just shy of $5,000 raised. Not okay. Not okay. We wanted $15,000 raised at this conference. And remember, we have a 2-for-1 match. So if you give us money, it turns into, if you give us $1, it turns into 3. You give us 15, it turns into 45. That allows us to give out scholarships. That allows us to give out scholarships to attend the conference, to travel to the conference, to pay for educational programs. And this is like, I think you can look around this room and see what a great job, what an impact this foundation efforts are having. We've expanded the scholars program. The scholars are here. Now we've got generations of scholars mentoring each other. This is how we do it. So you have a card on your table. There's a QR code, or you can just, if you prefer analog, that's cool. You can write, your credit card number and hand it to the staff out front. That's all good. However you want to give us your money, we'll take it. So, whoops, heel just went down a crack in the stage. That would be really bad. Okay, so please give us some money. We would deeply appreciate that. And so now, without further ado, I see we have our esteemed guest in the room now, all mic'd up. So, of course, she doesn't need a lot of introduction, so I'll keep it short. She was, I think, very saliently chair of the FDIC from 2006 to 2011. So she has some thoughts, okay? She's got some thoughts. You may not know that Sheila Bair, welcome, good morning. Yes, we are grateful to have you here. You may not know that Sheila is actually the author of a children's book called Money Tales, providing financial literacy lessons to children so that we don't keep repeating the same thing over and over again. Maybe. All right, so without further ado, so remember on your app, submit your questions. We're gonna just have a moderated conversation. Oh, actually, I need to grab, Elaine, could you hand me my notebook? All right, without further ado, we will sit down and have a conversation with Sheila Bair. Sheila Bair, please join me in welcoming.
Thank you, thank you, happy to be here.
So we sort of exchanged, emails on lists of questions, but I mean, they sort of ask themselves, don't they?
Yeah, sure.
So we've just had the second largest bank failure in history. First being Washington Mutual in 2008. Now in 2008, that was a bit of a bellwether moment. And
no bailout on that one.
So are we in a bellwether moment? Is this the start of something broader, or is this an isolated incident?
So that's a really good question. If I could just make one comment about it being the second largest failure. It's the second largest bank we allowed to fail, but we had a couple of big ones who were failing during the crisis, and I do think that's important. I think a lot of the instability you see now with deposits is because of this perception of too big to fail, right? So if we didn't have too big to fail institutions, the deposit volatility would be less pronounced, but that is part of the whole problem with the bailout culture that has, I fear, infiltrated our financial system, and the attitude that it's just too fragile to tolerate any kind of losses. And I think, look, these are hard decisions. I had to make a lot of hard decisions during the great financial crisis. So I sympathize with the regulators, but I just can't agree with this one. I think, Silicon Valley Bank, $200 billion. It was a very sick institution. I certainly hope it was an outlier. It was unusual, I would say. I don't think it's unique. There are probably others out there. It's like the old Warren Buffett saying, when the tide goes out, you see who's swimming naked. I think most banks have their swimming suits on, but I think there are probably a few that are naked out there. And when interest rates increases are stressing the financial system, they're stressing the real economy, and you get into the more kind of a challenging environment, the ones that are badly managed are going to be in trouble. And, banks fail. We have deposit insurance caps. That's the way the system works. And if we don't want that system, then it's really Congress who should change it. And my sense is right now we're using systemic risk determinations, which really are designed for my view, it's an extraordinary procedure that should only be used in extraordinary circumstances, to use that to bail out the uninsured depositors of two relatively small banks. I mean, total assets, $300 billion, and a $23 trillion banking industry. No, I just can't see that that's systemic, particularly since these were liquidity failures, and unlike the great financial crisis, there were still some good assets to sell for significant recoveries. So my guess is the uninsured would have had maybe a 10, 15% haircut, and they would have gotten, if the FDIC had followed its normal procedures, they would have got a substantial advanced dividend. That's what we do when we optimally, you always try to sell the bank have a buyer lined up before it fails. But when you don't, you make a quick estimate of what you think the recoveries will be and pay an advanced dividend, because the FDIC has been doing this a long time. They understand that those, especially the transaction accounts, the payroll accounts, provide needed liquidity, and they try to get the money back out fast to the uninsured to the extent they can, while still protecting against losses, their own losses. So I don't think it was necessary, and I do think, I know
So you don't feel like had they let them go,
yeah,
it would not have resulted
no,
in
I
sort of
don't. I
mass
think, I
deposit
don't.
flight?
No, I don't. I think a well-communicated resolution. You always need an aggressive communications plan around this type of event, and it has been a long time since we've seen any kind of a significant bank failure. So people, needed an aggressive communication strategy, explaining, reminding people we have deposit insurance caps. Vast majority of banks are sound and fine, which I believe is true. We had a very mismanaged institution here. It is unfortunate these things happen, and this is our process. And we're going to pay a substantial advance dividend to the uninsured next week. And the bondholders and equity holders are in line for first loss, as they always are and should be. So yeah, no, I think it could have been handled that way. But it's either or. So the argument that I heard was why they said these relatively small banks were systemic was because they were afraid that if they haircut uninsured, there would be broader uninsured deposit runs. So I do think they need to show their work on that. I think we have had some increased deposit pressure since then.
Right.
And I fear that by saying this was systemic, as opposed to saying, here are two very poorly managed banks, and this is what happens when you're a poorly managed bank. General reminder, banks do fail. There are deposit caps. I think that would have been less disquieting than all this drama around a systemic risk determination, which is, well, you can see the publicity.
Right.
It's been, nonstop
Right.
media coverage for a couple of weeks now. So again, I know these are tough decisions. You can argue it both ways, but boy, I would not have done this. I really wouldn't have. And it just, to the extent it reinforces this bailout culture. Nobody can take losses anybody anymore. Nobody can fail anymore. We're just, and this is a problem with the largest system in the accommodative monetary policy that we've had so long, and the relentless, continuous Fed interventions every time there's a blip. I think it just made us we lack resiliency now.
Right.
We're just every little thing, oh gosh, bailout, got to do bailout.
So the alternative strategy would be to have taken them over, done the standard haircut.
Right.
And then to say the communication strategy is this is an isolated event. These are extraordinarily
I would say
poorly-
unusual, not isolated. I think there are probably going to be a few more. There's some banks out there swimming naked, no doubt. But yes, that's what I would have done. they still had the option if there was, and again, they need to show their work. If there was evidence of deposit runs prior to these banks failing, it would be good to see that. I have not seen that, but it would be good to see that. But they have, look, Congress, we did a systemic risk, we're kind of reinventing the wheel on all this too, because we saw deposit flight during the great financial crisis from healthy banks, again, because they're too big to fail. The smaller banks were losing deposits to the big guys because of too big to fail. So we implemented a temporary account guarantee for transaction accounts, zero interest transaction accounts. We provided unlimited coverage. You could opt out if you wanted, so you didn't pay a premium unless you wanted to pay a premium for it, but a lot of banks obviously did, they needed to. It worked beautifully, it stopped the deposit runs. Congress, for whatever reason in Dodd-Frank, took the FDIC's, and we did it with the systemic risk determination. We did have an extraordinary situation back then. So Congress,
Indeed.
for
I
whatever,
remember it
yes,
well.
you remember that. So for whatever reason, Congress took that authority away from the FDIC and Dodd-Frank. I have my suspicions, but we'll set those aside for now. So anyway, so now you need to get congressional approval to do that. But there is a very locked down, fast track procedure. I mean, it's a rocket docket. Read 1105, I think it is 1105 of Dodd-Frank. President sends a resolution to the Senate, it's held at the desk, 10 hours of debate, up and down vote, no filibuster, no amendments. Same thing, passes, goes to the House, held at the desk, 10 hours of debate, no amendments, up and down vote. You could, and I think if we're seeing some deposit outflows from the smaller banks now, and I worry that, I guess the argument that the administration has used to not do that is that they don't want to just settle, they don't want to settle the system. So they've already said that there's a systemic problem with two relatively small banks, but they don't want to say there's a systemic problem to provide broader protection to the smaller banks. I don't get that.
So do you think the right decision now is to issue a blanket deposit insurance?
I think the right decision is to authorize the FDIC to be able to do that. They did that during the pandemic. The Trump administration, Republicans, the Trump administration requested it, recognizing this needed to be part of the FDIC's toolkit if there was severe stress in the financial system. So now I continue to think the vast majority of banks are fine, but to the extent there are uncertainties, I think it would be prudent to go ahead and get the authority now. The FDIC can invoke it when it deems it's necessary, but get it now, because deposit runs, the psychology of this thing, fear can drive it, and deposit runs can accelerate very quickly. And then to try in that environment to get congressional approval is going to be difficult. So yeah, I would do it now. It doesn't mean the FDIC has to use it, but they have it in their toolkit if they need to.
And one of the sources, I think one of the concerns about contagion was that while Silicon Valley Bank is, was extraordinarily mismanaged and unique in a lot of ways, given its customer base, et cetera, that there is a broader problem from mark-to-market losses on the securities portfolios. And that will be, again, the systemic borderline is going to be more important, and you could see money getting drained from smaller institutions who are also going to be more exposed to commercial real estate losses in this cycle. So I think that was the concern. What do you make of that sort of?
Well, yeah, I mean, there are various scenarios that I think loans don't have to be marked to market, and as you say, HTM securities, hold maturity securities don't need to be marked either. But let's just hone in on that point, because that's a problem for banks of all sizes. So we're kind of tagging the mid-sized banks. The largest bank, the smallest bank, if you've got it in a hold to maturity, you don't have to mark it against your capital. And there are a couple of large banks that have fairly sizable HTM securities. Now that's okay if they can really hold them to maturity, but that's supposed to be the rule, examiners and auditors. You've got to have the intention to hold it to maturity and the ability, the capacity to hold it to maturity. And if you have a very volatile deposit base, as Silicon Valley did, you do not have the capacity to do that. So I do think yes, there are these huge ATMs, but most banks have stable insured deposits and loyal, uninsured depositors. Uninsured, until now, uninsured have generally been pretty stable. And there's a problem with a lot of money in the system, a lot of rapid growth. Capital's been too cheap. That's been part of the problem. Social media is, feeding into deposit withdrawal frenzy. So I think the impact of that is a bit overstated. But yeah, I mean, it's an uncertain environment. But I do think we need to keep our heads and understand most banks have very stable deposit bases and do have the capacity to hold those securities to maturity.
Yeah, one of the new dimensions that people have talked about with this episode is the role of technology. You're not lining up at the bank, to get your pile of cash. You're transferring electronically, and you can transfer very large sums very quickly. So
Right.
has that caught you by surprise? Is this a new element of regulation and oversight?
Well,
Are deposits more mobile than they used to be?
I don't know. Some of us have criticized the Fed for a clunky payment system and likes and withdrawals. So maybe it's a good thing now that it's a little clunky. No, I don't know. Actually, we have a pretty inefficient. The system for moving money between banks is still pretty inefficient. So maybe I don't. I think
we're going to real time.
Well, maybe. I've been hearing that for a while. So yeah. So I think. I think the problem is less, technology facilitating faster withdrawals as it is to the speed with which information and fear can spread.
So the social media.
Yeah, I think that's my sense is more of a factor. Though I will say with Silicon Valley Bank, everything I've been able to learn about that bank, you had a herd mentality there. Whether it was a very close group. I mean, they all knew each other. Once started run, they were all going to start it run, and they didn't need Twitter to tell each other they were running. So I think that's it was a factor, but I think they still had substantial run risk even without that.
Right. So the mobility. I mean, one of the things that we've seen in the last few weeks that I find sort of, surprising, stunning, is that some deposits are leaving the insured banking system to go to money market mutuals.
Yeah. Well, there you go with bailouts again. I mean, so for goodness gracious, Fed, you are just intervening, you're buyer to every seller, seller to every buyer. I mean, so money market funds have been bailed out twice. They're massive users of the Fed's reverse repo facility, which enables them even more to provide bank-like services. They don't have the same level of prudential regulation. Yeah. But again, it's this government intervention that has created these distortions, and you're absolutely right. There's more money going into money market funds than it is into the big banks.
Yes.
And so that's, again, these bailouts create distortions in money flows, and unlimited deposit insurance. So people are talking about that now.
Right.
Okay, fine. You want to do that? It's going to be really expensive and probably primarily benefit very, very wealthy people with very large deposits. But then the distortion, so money's going to flow back out of money market funds into, if you've got unlimited guarantees, the money market funds only have implicit, not explicit guarantees. So that's another distortion you're going to create.
Yeah. So in that sense, to put that horse back in the barn, so to speak, would require a whole restructuring of what we've already put in place in terms of the reverse repo facility and all of that.
Yep. So it was funny when I wrote in the Wall Street Journal that facility when it first started, it was going to be temporary and very limited. I said, this is going to get out of control, and it got out of control. And it's expensive for the Fed too. Oh my gosh, the interest they're paying on reverse repo and reserve accounts is substantial and growing. Yeah.
So another focal point of this episode has been the role of supervision.
Right.
You understand all the chain of steps in the supervisory process.
Right.
What went wrong here? Do we know yet what went wrong here?
Yeah. Well, excuse me, I feel for examiners. I do. I saw this during the great financial crisis, that examiners were immediately fingered. When the regulations were weak, the capital rules were weak. I mean, there were and the tools they had, and the political support or lack of it that they had with leadership at these agencies, all was left wanting. So I think it's easy to blame them, but I have some sympathy for them. They're not perfect; they miss things, which is why I think we do need caps on it and deposit insurance. And I think we do need to encourage people to exercise some market discipline when they choose their bank. But they do need, I think there's this, this MRA and MRIA issue, and that there had been matters requiring immediate attention from the Fed, for these banks.
Just for the record, explain to the audience what is the significance of an MRIA?
Yeah, so it's not as significant as it should be, because there's not a really effective way to enforce it, and I've seen it. I saw it as a regulator. Banks will take years to remediate. They're called matters requiring attention, or the more serious ones are called matters requiring immediate attention. And examiners for most banks will get an annual exam, and the examiners will go in and they'll do an examination report, and they will flag areas of concern that they want the management to remediate. But there's really not a lot of muscle behind that, really.
Right.
It's just continual engagement, and you have, you can downgrade the bank, but even that, it's confidential. So, Silicon Valley was a 3, but I think that's not unusual. There's a lot of banks that are 3. A lot were downgraded after the great financial crisis, and examiners are much more pickier now about giving out those higher 1 and 2 ratings. But yeah, I mean, I think we haven't really talked about that, but giving the examiners, more, maybe should there, if you don't remediate, hey, after a certain period, maybe, management doesn't get their bonuses until they remediate, or start charging them a daily fine or
punitive
something.
steps that you can put into place.
Yeah, I mean, I'm sure the bankers out there going, but it's just, this stuff, I've seen it, it just goes on for years and years.
Right,
And then
it lacks
it does, and then there's disputes about what's full remediation, and then you need to get the internal auditor in there to validate it, and it can be a long bureaucratic process. When I think just the lack of agility in bank supervision generally, and in rulemaking as well, is a real issue here. I mean, as you all probably know, the Basel 3.5 process that started for bank capital after the great financial crisis is still going on. Hadn't finished it yet. So this needs to be, we need a more dynamic system and more effective tools when problems are flagged, getting them fixed, not waiting 3 years, but getting them fixed.
Would that require congressional authorization to give supervisors?
Probably.
Like limiting deposit or bonuses or?
Probably. And I think, I don't think examiners are perfect. So obviously there should be, but I think mostly they are right. And there needs to be a review process, an appeals process, the more you strengthen it. But also should be quick and efficient. But yeah, I mean, I think there needs to be more teeth in those examination findings and getting the findings remediated.
So you're sympathetic to the supervisors themselves because they just don't have the toolkit to enforce.
No, I don't think
because we know
they do.
from the reporting that people had identified some of the
they're pretty obvious. They were, yes. And but it didn't get fixed.
But it didn't get fixed. So supervision is one possible culprit, which you're saying we just don't have the teeth in the supervisory chain to affect the necessary changes. Now let's talk about regulation. This was a bank that had lobbied for and won a higher exclusion. What do you think things would have played out differently?
I think there's a lot of conflicting analysis about if they've been subject to the tougher liquidity standards, whether they would have still passed. Their capital, by the public measures that we can see, would have passed. It's not clear to me. I do think, though, I worry about this thing getting politicized. And I don't think
in this environment?
I know, because let's just objectively look. Let's not finger point. Let's objectively look about where opportunities for improvement.
Right.
So we talked about HTM securities, and that's true for all banks. There needs to be more rigor about what you can put in HTM. Available for sale securities for these mid-sized banks and smaller banks, they don't have to mark them against capital, even if they put them in a portfolio that says they might want to sell them. I think that definitely needs to be changed. I think certainly banks above probably 50 or 100 need annual stress tests, but the stress test needs to stress what's relevant, including interest rate risk, which has not been stressed. We're still so focused on credit and capital.
And this last war.
And again, for the very largest banks, I've been writing about this for a year and a half. The Fed has not, since 2018, the Fed has not, in their severely distressed scenario, has not tested a high rate environment. They did in 2018. Morgan Stanley and Goldman Sachs barely passed the leverage ratio. And then I guess the solution to that was to take the leverage ratio out of the stress, out of the hurdle you have to pass, and don't stress high interest rates. So now the Fed is always assuming if there's a distressed economy, they're going to take rates back to zero. Hello, is that what they've been telling us publicly? I thought we were holding course for fighting inflation. So that's not realistic. That is not what they're going to be doing. And so they need to stress what we're all worried about, which is high inflation, high rate, and an economic slowdown. That's what we need to make sure banks can survive.
Right. And that kind of there's a lot of questions from the audience, and a lot of them revolve around, the banking, the structure of the banking system, and how this is going to potentially lead to more consolidation. Part of that exclusion came from the desire to, help keep small and mid-sized banks viable.
Yes.
So how do we draw that line? Is this are we just going to end up with bigger and bigger money center banks and fewer and small regional banks?
And I saw a Bloomberg editorial, too many banks. Why is it every time there's a problem, people go after the mid-sized and smaller banks?
Yeah.
I will say during the great financial crisis, we really would have been in this soup if we hadn't had the regionals and the community banks.
Yeah,
They kept lending. Look at the data.
Yeah.
Look at the loans. Who was making loans? It was them.
Yeah.
Who makes the small business loans? It's them. So you're going to lose that. If you let all this, everything gets concentrated in a handful of banks, that's the system they have in Canada. It's worked for them, but it's a smaller economy, a less dynamic one, to its detriment, I think. And so, no, I don't think, and that's another reason why we might want to institute the FDIC's authority to provide a broader guarantee, because if you keep seeing this deposit leakage from the mid-tier banks to the biggest ones, that's what you're going to get. And even if by fiat, we're not saying, okay, we're just going to have a handful of big banks. Again, the distortions we've created with too big to fail and who gets bailed out and who doesn't, that's the system you're going to end up with anyway, and that would be very bad.
Right. So in the current environment, you think you could make the argument that for small and mid-sized banks, blanket deposit insurance would at least potentially stem the outflow?
I think you can. I think we need more data. It's been frustrating. I've seen some private sector analysis. I think it would be good for the government itself to provide more clarity around what's going on with deposit inflows and outflows, because we're all going through anecdotal press reports, but I think we need some official clarity and analysis on that. Yes.
Right. And so in terms of the Fed, right now there's kind of because the Fed is dealing with a very unpleasant combination of a banking system that's now experiencing stress.
Right.
And some of that stress is tied to higher interest rates, but there's a couple of questions here. Some of it is tied to potential loan losses, right? We may be going into a cycle.
Well, they're related, yeah. They're absolutely related, because you can't, and a liquidity crisis will come a capital crisis. If you have a deposit outflow and have to sell securities at fire sale prices, you're going to have a capital. So it's you can't. There's no clean distinction between these two. So and if we get into a severe recession, and this thing feeds on itself. So if we have a financial crisis, that's when not just tightening by itself, the tightening leading to a financial crisis, that's going to lead to a severe recession. That's exactly what happened during the great financial crisis, and it has happened several times before. Typically, when we've had extreme downturns, it's been triggered by financial crises, which have been triggered by interest rates going up. So everybody needs to take a look at that. I mean, it certainly would not be loosening anybody's capital right now. I think, Michael Barr is good for him, is out there, and I hope at some point I'm a poor substitute here, so I'm sure at the perfect time you'll be hearing from him too, but he's been talking about strengthening capital standards. Go for it, Michael. And this is, but he's getting a tremendous pushback, and the bank lobbyists still want to take Treasury, government securities, out of the denominator of the leverage ratio. So just you all know, there are two kind of capital ratios. One is risk-based, and treasuries are treated as zero risk for purposes of the capital rules, pretty much for the liquidity rules too, regardless of duration. This is back to your regulation question. Regulations created incentives for these banks to load up. And so to load up on government securities.
And long duration.
But they had a little bit of higher yield.
Yeah.
So that needs to be fixed, but also this idea that somehow treasuries are risk-free, and so you don't need to hold any capital against them, right? Because there's zero risk for the risk-based capital, so if you don't have a leverage ratio, 100% leverage to buy your government securities. That's of course what they did in Europe and had the sovereign debt crisis. The last thing we need to do right now is to be giving banks more incentives to load up on government debt. It's just not, we need them, we want them to take some risk, and we do want them to lend if we get into a downturn. Yeah. But giving them 100% leverage, they'll take our deposits and invest in government securities, and they can do that trade all day long. But who's going to provide loans to the economy? So you do,
I think you have experience with leveraged carry trades before,
That's right. Been there, done that.
Right. So I guess from your discussion, there's part of the discussions right now in terms of thinking about monetary policy and how the Fed handles this. There's this idea of a separation principle, that you can take care of the liquidity concerns and kind of set them aside and then address inflation with interest rate policy. My guess is you see that as a messier interaction.
It is completely. I don't think it's any secret that I supported Lael Brainerd for Fed chair when that spot was open. And I did not, because Jay Powell isn't a good person and has done a fine job. I disagree with some of the things he's done, but I think, he's dedicated. He's made tough choices, but he does not understand supervision. or regulation. And I think he's kind of made a point of saying, well, that's why we have a vice chair of supervision to worry about that. And you still hear that from some Fed governors and regional bank presidents as well, that somehow they're completely different things, and we can't let financial stability, I've seen them say that, we cannot let financial stability interfere with monetary policy. Paul Volcker, I hope a lot of you have read his book, Keeping at It, and if you're not, you should, because he does discuss, he was a strong critic of inflation targeting and this obsession with 2%, like there was some magic in the number. And he said, you keep accommodative policy, you keep zero interest rates in place in this elusive pursuit of 2%, like there's some virtue in having 2% inflation, you create this massive financial instability. And he's right, and it does. So it scares me that the people at the top of the house of the Fed still absolutely refuse to recognize the connection. Right. There's a very strong connection, and yes, they do need to take financial stability into account when setting monetary policy. And I'm an inflation hawk. I've been asking them to normalize interest rates since 2010. When all this I got a chuckle when I was at my last year at the FDIC in 2010. I thought we were going to start normalizing interest rates. I actually had a big banking conference on managing interest rate risk, silly me. Yeah, they kept it near zero for 14 years or so. So it's been unfortunate, and it has, fragilities have built up, and I'm hoping, and I still think we can get out of this without a hard landing. But again, if we have a financial crisis, they're going to have a hard landing. There's just no way around it.
Right. So right now they're facing a very difficult trade-off.
They are. Very
and
much.
You would counsel patience, or?
I would put up with inflation a little while longer than risk a financial crisis. I would, and that is not bailing out the banks. I saw that some people were criticizing. I've been saying to hit pause. They're bailing out the banks now, okay? So the JP Morgan Chase said, this new lending facility they have where they can, the securities that have lost value, they can still, pledge them at par and get a loan for a year. Okay, that could be due $2 trillion potentially. Right. They're pumping liquidity into the banking system already, even as conditions are continuing to tighten for the real economy. So I'm worried about the real economy. Right. I do not want to stress the financial system to the extent that we're going to have a financial crisis and then really hit the real economy, which is exactly what happened in 2008, 2009. So that is not what's going on. A pause is not bailing out the banking. That's already going on with these new liquidity facilities. It's helping the real economy, particularly the labor market.
Right. So stepping aside from the current crisis, we had a panel yesterday on digital currencies and CBDCs, and we had Nellie Lang here, and an excellent panel. So, what are your thoughts there? I think one of the things that's being illustrated in this moment is how quickly banks can be potentially disintermediated.
Yes, that's true.
What are your thoughts on digital currency?
Well, I think it's got tremendous promise. One area where I think hopefully we could all agree, and it doesn't have to be CBDC. I mean, the Treasury could do it. Is using digital currencies and smart contracts for government payments. And there's been so much fraud. We put a ton of money into the economy during the pandemic. Probably more overshot that, obviously. There was a lot of fraud. I mean, you had to get it out quick, and so I think that's just the price you have to pay. But using, I think, a digital currency distributed on a blockchain using smart contract technology could be a really smart and efficient way, no pun intended, to get benefit payments out to the people. It's the person you want it. It's going to be used for the purpose you want. Whereas now, sending out debit cards or whatever, it's clunky. And so I do think, and there's a lot of fraud, so I do think it would have promise there. Longer term, I think, using it retail for monetary policy it could be a more elegant way of the way when we do need to provide monetary stimulus, providing money directly to households as opposed to lowering interest rates and relying on the financial system to make a lot of cheap loans and all the leverage and build up and asset inflation that instability that creates. If you want to stimulate the economy with money supply, just feed it directly into households. The reason, my view is the reason we never had inflation for nearly 14 years, even with this extremely accommodative monetary policy, it was not getting to consumers. It just wasn't getting consumers. It was kind of staying in the ether of the financial system. Once the Fed started essentially monetizing the debt, financing these massive deficits, which allowed the government through fiscal authorities to put payments to households, that's when you got consumer price inflation. So the lesson for me on that is not to not make payments to households. The lesson for me is it's a lot more efficient if you want to provide monetary stimulus, just pay households directly.
Yeah. So you could get more bang for your
buck. A lot more, much smaller increase in money supply.
Much smaller increase.
Not the buildup and leverage.
And much less financial stability risk building.
Exactly.
Right.
Yep.
Right.
Absolutely, yeah.
Excellent.
Yeah.
So and apparently it has been. So Janet Yellen is going to speak to us this afternoon.
Excellent. Good.
And apparently the topic of her speech is bank regulation. So we will see what she has to say. Any last things that you would like to say in terms of, what we should keep our eyes on?
I've always respected this group so much, and I've spoken to you before and participated in your events. I do think if you can keep reminding regulators the importance of economic incentives and regulations, and look at the regulations themselves, and some of the activity you see that you don't like is because of the incentives that regulation creates. And I'm always for trying to align economic incentives with regulatory objectives. We don't always do that well. We create the wrong incentives and then try to micromanagement through prescriptive regulation. I just don't think that works. So,
right. Yeah. Well, and we have some examples right in front of us that we unfortunately. All right. Well, thank you so much for joining us at short notice.
My pleasure. Thank you. Thank you for having me.
We don't see Bill Spriggs yet, but we'll add the
Good meeting so far?
We're live.
I'm in and out today. I'm heading back on the 2:15 train back.
I wish I could spend more time with you. Wish I could spend more time with you.
Sure.
See you.
It's good to see you too.
Good morning, everyone.
Do more together.
Can you? I'm not sure of it. Good morning. Welcome, everyone. My name is Lydia Boussour. I'm a senior economist at EY, and today I have the honor and pleasure of moderating this panel on the labor market titled "The Labor Market is Not Just Human." So as you all know, we've seen some extraordinary changes in the labor market since the pandemic hit 3 years ago. We've seen a massive shift in workers' availability, but also in their expectations about their jobs and about the workplace. And these changes have generated those large labor market imbalances that are still having an imprint on the labor market. We've also seen the cost of labor increasing very rapidly, and for companies that has put the onus on productivity growth. We're seeing more and more companies turning to technology as a way to overcome some of these challenges and also bridge the skills gap. So a key question is really, where do we go from here? Where does the workforce go from here with AI and technology likely to play that increasingly important role in the future of work? Now, fortunately, today we have a great panel of experts to answer some of these questions, starting with Diane Swonk. She's the chief economist at KPMG. Diane has a very extensive career as an economist in the financial services and consulting. She's also, she regularly briefs the Federal Reserve Board and its regional banks, and she's also currently on the US Chamber of Commerce Economic Advisory Board. And to her left is Nela Richardson. She is the chief economist at ADP and the co-head of the ADP Research Institute, where she leads the economic research effort. She also has an extensive career as an economist. She serves on the foundation boards for the US Chamber of Commerce and is a member of the Bureau of Economic Analysis Committee. So we're going to start by hearing some thoughts on the current state of the labor market, and we'll then move on to the Q&A session. So Diane, why don't you start?
Sure. Well, it's really an honor to be in front of NABE like this, and also to be with one of my dear friends, Nela, who I admire, worship at her altar and what she's doing right now. So I think it's really important to think about how the labor market is likely to react to the current stresses that we're seeing in financial fragilities in the US economy today. And we did a lot of work in our own group about what was causing the extraordinary surge in demand above and beyond the levels that we saw during pre-pandemic era, even as we got to 3.5% unemployment. And the major shift we saw post-pandemic was a surge in demand by smaller firms with less than 250 employees. And we also saw during that period, there was sort of two waves of applications by high propensity businesses who got a tax ID intending to hire. And initially, we looked at, actually, my colleague, Elaine and I looked at the number of people selling masks on Etsy as we went into our initial lockdowns, and sure enough, they overlapped pretty closely. But as the pandemic continued to progress, and we had this ultra easy financial monetary policy, we had stimulus, a lot of things started to shift. And in July of 2020, we saw the surge in the high propensity, the first wave of the surge in the high propensity businesses applications. And then from January 2021 to June of 2021, we saw another surge in those applications. As of January of 2023, the business applications for those businesses that wanted to hire up, not just be self-employed, were still running 40% above the levels we saw in the 2010s. It was simply stunning. So we started to break it down and look at, did this have any role in terms of the extraordinary surge in demand for workers? Now we know the JOLTS data, not perfect. It's still showing that we're running, 7 million job openings in February of 2020. As of January 31st, there was 10.8 million job openings. Well, that's not perfect data. We also look at, I know Nick Bunker is here, we look at the Indeed index, and that has come off the highs, but it's still well above the levels that we saw in February of 2020. And so we've looked at a lot of high frequency indicators as well, knowing the response rate is not as great in JOLTS. I think Ryan Sweet on my panel yesterday said, the response rate is now down from 70% pre-pandemic on the job opening and labor turnover survey to about 30% today, which is something we all have to grapple with, is how good is the data? Our data is our only way of mapping out where we are, let alone trying to understand where we might go. That said, looking at all of that, the Boston Fed looked at these high propensity business formations in a great paper, and they were finding that the conversion rate of these businesses into establishments that hired had been compressed. And we looked at the same stuff. They had used to take 8 quarters for a business to start up and then start hiring, all of a sudden went down from 1 to 3 quarters, which our analysis actually backed up. We also looked at what role did the surge in these new business formations play in terms of generating actual job openings and actual hires. Now, the Boston Fed research showed that by the middle of 2021, second quarter 2021 to the first quarter of 2022, new births were adding 1 million jobs a quarter to the overall economy. So it was clearly playing this huge role. Our own analysis suggests that over half of the excessive increase in job openings that we saw coming out of the pandemic were due to, very different than pre-pandemic era, a huge break in the data, were due to these new business formations and the hiring up they saw. Why is that so important today? It's so important today because those businesses, 250 persons or less than 250 employees, are the backbone of the job gains that we've seen most recently. And if those are the businesses that are most exposed to where the credit tightening is likely to come in the US economy, which I believe they are, it's one of the things Sheila Bair said when she was up here, the role that community and regional banks play in providing credit to those very institutions, you are going to see a much more dramatic slowdown in employment, not a fast cliff event like we saw in 2008 and 2009 or during the pandemic. But I really think it's sort of ridiculous that we keep sort of looking at these sort of events as a threshold. Those were extraordinary, horrible events. And I also think it's, I think it's something I heard yesterday, and it, nothing against Brian Sweet, but he said, well, we're going to have a garden variety recession. I have been working for a very long time, and I don't know what a garden variety recession is unless we live in a jungle. I mean, every recession is different, and every recession has pain and has scars. And, I've been tracing the scars of these in the labor market for decades. I've been around that long enough to do that. And, I remember them, and I remember living them. I became an economist because I grew up and came of age when my best friend went into poverty. Because her father died and her family had no food. And so, understanding that in the labor market, that this is going to have stresses and repercussions, I think is really important right now. And it's why I actually agree with Sheila Bair in terms of the Fed pausing and taking a sight. I've always argued that, fighting inflation is a marathon, not a sprint. And if your only tool to do it is to hammer the labor market because that's the only place you think you can do it, then, perhaps you might want to pause for a second. And I agree with what Sheila said, in a marathon, the hardest mile to get through, many a central bank has fallen by the wayside, not getting through that hardest mile of 21 to 24 in terms of getting over the finish line. But to get to the finish line, to get through, and I'm a runner, your mind and body wants to quit. In order to get your focus on the finish line, you need to pause and take a breath. And I think that's where we are, because I do believe that we're going to see a tremendous amount of job losses in what was the very backbone of what made the resilience and remarkable strength that we've seen over the last year.
Thank you, Diane. I'd like to welcome also William Spriggs. He's an economics professor at Howard University and the chief economist to the AFL-CIO, where he chairs the Economic Policy Working Group for the Trade Union Advisory Committee to the OECD and serves on the board of the National Bureau of Economic Research. So do you want to start with a few thoughts on the current state of the labor market?
Let me start by saying amen to what Diane said. So I'm more than discouraged with the Fed. I'm fed up with the Fed. There were a couple of strains in policy thinking after the Great Recession, one of which was a realization that there is a decline in the natural interest rate. And so not only are policymakers confronted with a zero lower bound, they actually are confronted with a very low ceiling of how high you can raise rates before something bad happens. And we have to remember that right now, the Fed is very close to the interest rates that triggered the Great Recession. So for no other reason, there needs to be the pause for that. But more importantly, is their absolute incompetence in talking about the labor market. The labor market has already slowed. Since November, the unemployment rate for Hispanics has begun to rise. And contrary to anybody who says, oh, there's a labor shortage, understand why. In the case of Hispanic women, labor force participation has continued to recover above pre-pandemic levels. So the labor supply of Hispanic women has been recovering rapidly, but their unemployment rate has also been rising. This is absolutely impossible if there's a labor shortage, because we're adding workers, but we're adding more unemployed workers. If there's a labor shortage, that's not how that works. Now, in the case of Black women, their labor force participation rate has also been rapidly recovering. Fortunately for Black women, there's a trend towards a lower unemployment rate. They're better educated than Hispanic women, so they've been having a little bit more success at landing jobs. But it has been very uneven. In several months, like last month, the unemployment rate for Black women went up. Again, labor force supply is up, unemployment is up. That's not a labor shortage. Why am I talking about Black and brown workers? It's a matter of demographics. The labor market moves on the margin for the entrance to the labor force. The majority of entrants to the labor force are people of color. This is the simple demography of the United States. There's a decline in the share of the white population. It's most prominent, of course, among younger workers. So if you're looking to understand what is going on in the labor market, this is why you have to pay attention to the Black and brown labor market, because they're the workers who are changing the numbers. It's their numbers that are on the margin of what's going on. If you want to define something as a soft landing, then a soft landing would be, we're going to slow the rate of job growth so that it's in line with labor force participation, maybe a little behind labor force participation, and we will get modest increases in unemployment when we shock the workers that we're not generating enough jobs. The problem is that the Fed continues to harp on the unemployment rate, and here's the problem. If you don't keep generating jobs, the black and brown labor force participation rate will drop. It's very sensitive to whether you're actually creating jobs. So when the labor force participation drops, these rises in unemployment that I had just been talking about go the other way. The unemployment rate actually will go back down. So what you'll have to do, if you're going to continue to be stubborn, pig-headed, is you're going to have to induce net job loss. And as Diane just warned, well, there's no such thing as, I've heard from the Fed, oh, well, the unemployment rate will go up to 4.5%. Like, once you start a recession, you started a recession. Once you start job loss, you started job loss. There's no such thing as it will stop at 4.5%. Like they're steering a sports car. They're steering a bobsled. They only have a brake. They do not have a way to accelerate, and if they crash the bobsled, then we're in trouble. Now, during the run-up to the Great Recession, the Fed ignored black and brown unemployment. Ignored it. Now they say, well, we give lip service to it. At least in our meetings, we hear about it. Okay, but listening to the unemployment rate isn't analyzing the unemployment rate. It's not understanding the signal that the unemployment rate is telling you. The more disturbing number is for Hispanic men because they are the ones who are most sensitive to what's happening in construction. And as we slow residential construction where they dominate, then bad things happen to Hispanic men. Now, their labor force participation has been rising and then it started to fall, and it's also because their unemployment rate is going up. This is a bad signal. And it is the signal that the Fed ignored before the Great Recession. They acted like, oh, the labor market is still doing well. No, the labor market is not doing well. And so this willing ignoring of clear signals that the labor market is not tight, that it is slowing, is dangerous. Now, I had a little bit of confidence in them that maybe this time they were paying attention, maybe, but then SVB failed right in their backyard. And so the idea that they're paying attention just went out the window for me. And so I have no confidence in them at the moment.
Thank you.
We're at a very unique point. I just want to add this one point though. I mean, because everybody's always on me about this. Why you worry about unemployment and black unemployment and all this? Understand that in a normal labor market, the unemployment rate for white high school dropouts is lower than the black unemployment rate. Because I know there are a lot of you out there who probably say, but why aren't you talking about training and education? That's the problem for black people. The unemployment rate for white high school dropouts, white people with no education, is typically lower than the black unemployment rate. Only in the last 2 months, have we finally reached the point where the unemployment rate for white high school dropouts is higher than the black unemployment rate. We have only reached 2 months where education actually matters in terms of trying to understand why is the black unemployment rate different than the white unemployment rate. We're not all the way there yet, but at least we're to the point where you can have a conversation. This is what the Fed is risking.
Thank you, Bill. Nela?
Well, first of all, I just want to thank NABE for hosting this panel. And you can all see now why I was so excited about the panel. The ability to have a conversation with this level of expertise on the labor markets is unique. And so I think we've all embraced that in the last 10 minutes. What I'll start by just offering is that, in my view, and this is a view informed with the data that ADP has on about roughly 20% of the US workforce, is that the labor market is incredibly tight, but also, as Bill has gone into deep detail, incredibly fragmented. The pandemic impacted industries in different demographics very differently. And so to look at the labor market as a whole misses the whole point. The whole point is that we are in the midst of an evolution that is quite fragmented. And I thought, you know, when we saw those 20 million jobs leave the labor market in spring of 2020, I thought to myself, you know, for the next expanded period of time, we're all going to be talking about the jobs recovery. But the exciting stuff happens once the jobs have been recovered, because that's when we're left with the structural impact of that loss. And that's what we're dealing with right now, the structural impact of the loss. Very different from the cyclical boom and bust cycle that we're used to talking about in the context of monetary policy. And to amplify that point, you need only look at the productivity numbers. Last year was the first year where we saw annualized productivity increase at a rate this low since 1974. Now, there are not many things that have happened before I was born, so I had to point that one out because I think that is a really big—
I was already alive.
a big factor. Well, that's, you know, I'm going to use it like I can.
No, it's okay.
But we're talking about the labor market, how the labor market and how eventually we're going to talk about technology and AI. And, you know, I spend a lot of time with my son on ChatGPT. And why is this not plugging in to the moment that we're in now? That's a big question. That's a structural question. Just like Black and brown unemployment is a structural question. And these are the questions that are defining the fragmentation. But what it's looking like tightness right now. For the observable eyes, the folks that are not going deep like Bill and Diane, it looks like tightness. It looks like high wage gains. We always talk about things as if they're universal, like wages are going up and they're going up a lot. That is true. But you look at who's getting the wage gains. It's the people at the lowest part of the income distribution. And so when your annual salary is $27,000 a year, or your hourly paycheck is less than $11 an hour, that big wage gain looks like $1.50 an hour. It looks like a couple thousand a year. And then it gets erased by really strong inflation that impacts things like energy and food, the stuff that you spend, and housing, the stuff that you spend the bulk of your income on. And so, again, we're seeing that trend play out in wages. The lowest income folks have seen the strongest wage gains, mainly in leisure and hospitality, still double-digit increases in wage gains. If you match individuals the way we can at ADP through time, you're seeing really strong wage growth, but it's not necessarily translating into better outcomes in terms of spending if it's eroded by inflation. And Diane mentioned the fact that small firms are basically the anchor of the labor market. It's true. During the last 10 years before the expansion, most of you are familiar with this fact, they created 2/3 of the net new jobs in the United States. And according to our data, they were the first to start hiring after the downturn. It was small firms that took that brave first step back to trying to get their workers back. But we've seen them over the course of the recovery be outmanned by larger firms who can offer bigger benefits and more attractive wages. And so for small firms, they're still trying to find qualified talent. Now, they may be looking in the wrong pool sometimes, but it's still a challenge. When we survey firms, it's really difficult to find the folks they need to fill the jobs that are available. And that's what they're trying to figure out. So I do think there's a role. We can quibble with how that policy gets distilled, but there is a role for education and skill development and connecting the demand for workers with the supply of workers. So we have the productivity angle, we have this fragmented labor market that is tight, we have strong wage gains that are still a challenge for smaller firms as they're trying to add headcount. And then we got to remember that there's like a whole other world out there outside of the United States. And that world is seeing some of the same trends that we're seeing here domestically. We're seeing a return of high inflation, which in my view is not going back to sleep for 40 years. It's still going to be pretty, episodic given all the different global events that we are witnessing in a complex world. We're seeing lower labor force participation. We're seeing a big increase in the digital economy and the demand for new technical skills. We're seeing a concentration of labor in some areas of the world like Asia, which is very different from the concentration of wealth. That's got to be figured out. We're seeing shortages in the care economy, which allows people to work, especially women, especially Black and brown women who are both, over concentrated in that sector of the economy, but are very reliant on that sector of the economy as well. So all of these trends are playing both domestically and globally, and that's why we can't think of them as cyclical. They are structural and part of in my view, the new world of work that we're all going to be talking about for a very long time.
Thank you, Nela. So on this cyclical versus structural labor market dynamics, we've seen the labor supply respond pretty slowly during this recovery. And we are now seeing some signs that these labor challenges are starting to ease in some industries. So Diane, do you see this labor market tightness that we are facing right now dissipating over time, or are you expecting a structural labor supply shortfall going forward?
Well, I do think that we do have structural restraints on labor, and they come in a lot of different forms, and Bill has talked about some of them in terms of education, and so has Nela. I do think there is a structural labor shortage, but it's really important to understand. One of the things that I keep looking at we do a survey of our CEOs and CFOs and C-suite individuals to see what their expectations on inflation are, what their expectations on wages are, how do they want to deal with it. The number one thing they want to do is employ labor-saving technologies, because they all see what we are going through as something more structural, that they can't find workers, than cyclical. That said, and that's even as they expect a recession, which is really an interesting dynamic. That said, there is this mentality, and I think this, it will resonate with Bill, that employers really haven't gotten used to this idea that workers are commodities. I think during the 2010s and for several decades, to be honest with you, that workers were seen, we broke down the social contracts between workers and employers, and in doing that, workers were seen as sort of interchangeable commodities. And there wasn't a lot of investment in workers. And you look at, where has the investment been the shortest? Well, it's by local real estate tax revenues, and a lot of school districts that didn't have access to those real estate tax revenues did not educate their children. There were other structural issues and ideologies that stopped educational improvement for many children. But the idea that we have got, you now see firms looking to employ labor-saving technologies, AI, in a different way, in a way to substitute capital for labor, instead of bridging the skills gaps that exist. And that is not how the tire meets the road on productivity growth, is when you marry the two, not when you think of them as substitutable. And I think we went from a world of globalization, which had a lot of benefits, but also a lot of costs for the labor market, where you saw cheap labor as an abundance. And now it has disappeared with geopolitical tensions, harder borders, less immigration. I mean, from February 2020 to February 2023, the labor force grew by 1.8 million people, 1%, 1/3 of the pace of the 2010s. Yet the only reason it grew was because we had found 2.1 million immigrants have made it to the United States in the most recent benchmark revisions. And so absent those immigrants, we would have had a contraction in our labor market. Now, what I really worry about is how the pandemic also amplified inequality in terms of educational attainment and how firms need to think about embracing these technologies to leverage the skills gap. Black and brown households were online longer. They stayed pivoted online education longer. We know that men fared worse online in both K through 12 and college, worse than women. Women fared the pivot better, and they dropped out more. But the fact that you also structurally left lower income households further behind in their educational attainment as well. And you're complaining about not being able to find these workers and cast a wider net. First of all, human capital is malleable. People there's talent that I work with that you unleash every day in someone you wouldn't expect. And the way that we think about labor and leveraging technology instead of, we don't think about leveraging it in a way to enhance the ability of people to work and to get people more productive to work for us. And I think that is something that we're missing in the equation. And that's some of the structural issues that we're picking up out there is, yes, firms have decided it's a structural labor shortage. There's not as many workers and cheap, easy workers to use and abuse in certain ways that they did in the past. And that's pretty pointed coming from me, a corporate economist for all these years. But I think it's an important way to think about it. And on the flip side of it, now they're thinking going forward of substituting, not really getting the productivity growth of helping these technologies and also investing in workers and training them and bringing them back into the labor force in ways that I think are more creative and actually would solve a lot more of our problems.
So we're hearing a lot about ChatGPT and artificial intelligence, and it's showing promising applications across many different sectors of the economy. Bill, I know you've looked at prior episodes of technological changes, rapid technological changes, and how that impacted workers. So how do you see this impacting the workforce, and what lessons can we draw from history when it comes to the role of institutions and governments during these periods of rapid technological change?
Well, the current group of folks overplayed their hand and declare themselves to be the new coming, but our most rapid productivity growth occurred when we engineered a far more equal distribution of income, which built the middle class, which built a growing demand that had to have automation and productivity growth, because that's the only way companies could keep up with demand. They simply could not throw more workers at it. They had to have more productive workers, and they had to figure out how are we going to get workers to be more productive. So when you look at the early innovation period, then it is about greed. It really is about extracting as much rent out of the early patents. So when you think about the early part of the 20th century, and that had rapid productivity growth to it, but in the modern era, the post-World War II era, it really was by creating a middle class and growing demand. And so that's what's missing here. I think Diane hit it correctly. The tech industries view themselves as rent extractors, and therefore they prefer a technology that substitutes for something else because they're rent extracting. It doesn't really add to the equation, and often it doesn't go anywhere because you actually need productivity growth because I need to meet demand. Productivity growth for its own sake doesn't do very much. I am hopeful that by disrupting the low end of the labor market as we have, and this is the big structural change that has taken place. One, we've been increasing the minimum wage in enough states that the majority of workers are getting minimum wage increases, which are 10 and 12% a year. Because when you go from, if you look at the legislation in these states, right, they're going from 7.25 to 15. Each year, they have to raise the minimum wage by $2 an hour or $3 an hour. So people are going from $10 to $12 an hour in a year. So of course we see these big gains. But we disrupted the other part of monopsony in that market by destroying the job networks, which were part of the way in which the labor market discriminated and companies exerted monopsony power. They are now forced to post their jobs. This is a real structural shift. So they have to have more job postings because they can't use the job networks, and open knowledge about jobs switches that labor market, makes it more competitive. The reality is, how could you have had a 21st century in which you lost 6 million manufacturing jobs and gained 6 million jobs in the lowest industry, leisure and hospitality? This makes no sense. And so it didn't make sense for us to have that many people trapped there. The nice thing about the loss of the jobs and all those networks is the transition that women and Black workers have been making out of that trap. This is why, finally we're seeing firms recognize that the Black labor force had been so underemployed. This is why finally a Black person with an associate degree has a lower unemployment rate than a white high school dropout. Because companies now have suddenly started to go, oh, well, I guess this is the applicant pool. And some of them are reluctantly waking up to the fact that this is what you're going to get. So it's either them or nothing. So that's the good thing here is this upskilling and this switching out of these low-wage jobs. Now, the low-wage industries probably will have to figure out, what do you do with fewer workers? There was no reason for them to have had, at the onset of COVID, remember, we had 12 million manufacturing workers and 12 million restaurant workers. What country has the same number of hamburger flippers as manufacturing workers in the 21st century? So this freeing of this workforce will undoubtedly mean that, yes, those companies are going to have to figure out, what do you do when there are fewer low-wage workers? That'll be a good thing. Hopefully, this pause that's taking place with ChatGPT, a lot of this artificial intelligence is again pushing the boundaries on the part of tech over things we wouldn't have allowed before. The real thing about tech is theft. A lot of what gets generated isn't different than plagiarism. I am not yet convinced. I know that they've convinced themselves, but I am not yet convinced that the computer isn't doing anything more than, I have a huge library, and so this is a student who now has an infinite library and infinite capability of plagiarizing. So we let them get away with this all the time. They claim that they have some new technology and we're wonderful and we're brilliant, but so often what they're doing is ripping off something. And so hopefully part of the pause that they've asked for will be a pause so that we can reclaim some space. The fight over TikTok, for instance, is a fight over knowledge of our personal data. Like, we should have this fight over Twitter. We should have this fight over Facebook. But why are we having this fight only over TikTok? And that's a part of the revolution that we've been seeing take place. I don't think a lot of this is actually productivity enhancing as much as it is rent seeking. I can steal the talent of human beings because I can plagiarize really fast.
So there is a question about productivity, and we all know that it's very difficult to get a good pulse on productivity and let alone forecast it. Nela, how do you see measuring productivity in this future of work evolving? How can we better capture these productivity gains? Because there is this sense that all these innovations that we are seeing are not being captured in the data.
That's right. I think that it's really important that we measure it correctly. I kind of hold a couple of truisms about the labor market and how it grows. One, more inclusive economies create more jobs and have better productivity. You can see that when women entered the labor market, when barriers started to fall in terms of Jim Crow, in terms of more people having access to the labor markets, the economy grew. I find productivity to be anti-inflationary. It lowers prices because you can create more with fewer inputs. I think also, though, realistically speaking, we are just at the beginning stages of large language processing models and what they're going to do for the world of work. Now, the copyright issue is huge, and I'm not going to address it, I'm not a lawyer, but there is a sense, I think, out there in the corporate sector that this technology, it's like you want to know. I would expect that most big companies are trying to figure out what this technology means to their business, to their competitors, to their sphere of influence, and to their headcount. It's not just about employing labor-saving technologies to meet the moment of headcount hiring today. It's about what does the next 10 years look like, the next 20 years look like, and will my company be left behind if I can't figure it out? And so in that sense, there's an opportunity. There's an opportunity to figure out how best to deploy these new technologies, because pretty soon they're going to be like my son's calculator that he carries around in his backpack, just a tool. You either know how to use it or you don't. But if you know how to use it, you have an advantage. That's the promise here. It will be ubiquitous, but we're at a stage where we can define it better before it overtakes this transformation that could lead to worker displacement. So I'm actually thinking that measurement right now is more important to ever. And we've seen some really good early attempts in the last 2 years from the statistical agencies to use surveys like the annual business survey and add a technology and technology transformation module to those surveys so we can better capture how companies are investing and adopting into that new technology. If you add that to private data sources like ADP, like job postings, I know Indeed is here, LinkedIn, all of these posting data that has actual occupations and task levels, and all the machine learning that is going on to distill those tasks and measure those tasks and see the demand for those tasks, I think we can better capture not only productivity, but how these technologies are affecting productivity, and not just every quarter. There are other efforts afoot to measure things like retail sales and prices, not just quarterly, but daily, hourly. We're in this fast-moving digital economy. Being able to use private data sources along with government data sources to really benchmark and track is going to be how we keep up with that change. Maybe not all the way. I feel like that change is going to happen a little faster than we can keep up with it, but it's a good start. So how do we go deeper into these sources? How do we make them more plentiful to prepare for the future, which I think we'll see a lot more of these models at least amplifying and enhancing worker productivity.
So we have a question from the audience about the impact of AI on employment. And there is really this fear of job losses and job displacements. So Diane, do you want to comment on the impact of AI, and how do you see employment and the workforce being impacted in the coming years?
You know, it's just an interesting issue because it's one of these things where we've talked, if you listen to full out AI people, they're going to tell you it's going to take out a lot of workers. And in fact, I think it came up in one of the panels yesterday that we need to, I think it was Maya McGinnis talked about how we needed to think about our policies in terms of the labor market, because we may end up having an excess supply of workers rather than a structural shortage if in fact it displaces that many workers. If you believe how much it's going to, what was it, 10% believe it's going to destroy humanity of those people who are designing it. Having my father at the cutting edge of technology my whole life, I learned to respect technology, but also one thing he taught me was that it also has a good and evil side. And that, he was very worried his whole life, and sadly he passed too soon in this life, but he was very worried in his whole life about how much he knew back. He was one of the first people who designed those Y2K programs. I don't know if you guys remember Y2K. He was one of the first ones who wrote one of those programs, and he couldn't believe that they were still, and he fixed it before he left General Motors Corporation with the largest data warehousing program at the time that GM had ever seen. But so I knew the world was okay because he had fixed it. So I wasn't worried on January 1st, 2020 or 2000 that the world would fall apart. But I think what was interesting to me about what I was taught about that was how much they were storing all this information on people for a long time. This is nothing new, and the loss of privacy that that Bill has talked about. I really think that this is going to rock our world. We know it. It will precipitate a bubble, much like because people will run to invest in the sector before we know who the winners and losers are and how it will shake out. What I worry about, and I think Nela and Bill have both pointed it out, is the need to put parameters on how is it used, how is it best used, what are best practices. It will be ubiquitous. I absolutely agree with Nela, and I do worry about the backlash to something. Technological backlash to technological revolution is nothing new. There's a long history of it. I'm sure you can cite all of it, Bill. It's nothing new. We don't want to adopt it so quickly that we cause such large displacements that we actually undermine demand and get productivity growth that is not as productive for the overall economy and inclusive. And I think that's the real challenge. So I am worried about it, and I'm worried about it in a not this year or next year, but within 5 years, 5 to 10 years. I think it's a real issue.
And if I could add on to that, because I think it's important, but I don't think it's the whole story of the labor market, because the BLS put out a report in November of last year saying that employment will grow at half the rate over the next decade as it did the previous decade. And one of the major reasons is because of retirees and the aging demographics of the United States, which means the jobs of tomorrow are not sitting in front of a computer. So these chat GPT large language models, basically the promise is to wipe out everything you've done on a computer and do it for you. But a computer doesn't take care of your aging parent. You can't leave your child with I've tried to leave my children with computers. I have done it. I'm sorry, the iPad, it does help. But
it does help a lot. Even
with
my kids, when they're older now, but sometimes they act younger, so I just give them an iPad.
So, let me qualify that. But the jobs that are needed in terms of an aging demographic are not computer-based jobs. So yes, technology is important. It's going to, maybe automate my job, but the job that is needed by my son to take care of me may not automate that job. And so it's really important that we don't concentrate on tech when the service economy, especially people services, health services, are so critical to the underlying structure of the labor market. So I think that could be the trap, that we look at a puck that is going a little awry from where the demographics are going. So we're not meeting the puck to the future. It's a little left, a little right, but not quite spot on center in terms of the demographic needs of an aging workforce and an aging population.
Well, and just to underscore this point, this gets to the point that I was making in the beginning, where the magic is when you marry and technology with human beings. And there is a famous CEO that had a completely automated plant that was punching holes in all of his batteries of his electric vehicle plant. I won't say who he is. He might own another Twitter kind of platform right at this point in time. But he said he had undervalued the role of human beings, which wasn't surprising to me that he said that. But I think, the technology now that we're talking about also enables those caregiving jobs to improve the quality of life, not only in the ability of caregivers to assess what's happening with someone who needs help by scanning their bodies and by giving them updates and by sending them to a place that can say, hey, it's time to take them to the emergency room right now, or their medication is a little off right now. That can enhance caregiving. That can enhance those jobs in ways that we could not imagine before, and improve outcomes for both the worker and for the person being cared for, and make it more efficient, but it works together. And these are the things, when I've seen the programs that for premature babies that can scan a baby's body, and the doctor doesn't have to touch that that baby to go in and intervene on something, because just by touching it to get the vitals of that child, it can increase the risk of that child dying. The fact that it can find out what it needs to do and then do only what it needs to do, that doctor is now a better doctor. The same thing can happen with caregiving. And I think we need to think about these technologies in that holistic way, because that is really important in terms of how we, not just the rent-seeking portion that you laid out, Bill, but where the magic is our ability to increase our standard of living and our quality of life.
So we're gonna pick up one more question from the audience, and maybe Bill, you can give us some answer here. Is there a way to make sure that lower income households are not left out in this transition to the future of work?
Well, the dominant workforce that does personal services is likely to continue to suffer from lower wages. Just, it's very hard for us to shake the structure of caregiving because it's viewed as women's work and upvalue it to the level we should. It may happen because as we have become a much better educated workforce, we've never fulfilled the promise. The younger generation is definitely better educated than the older generation that is retiring. They are very well positioned to take advantage of that. We have to figure out how we agree in our minds that this essential work gets paid fairly. So far, they're winning because enough states have raised the minimum wage. The people at the bottom are keeping real wage growth. They are experiencing real wage growth above what's happening to inflation. But this is one moment. And we still have left behind too many states that have not raised their minimum wage. And so there's going to be a challenge there. We have a huge challenge in terms of their resiliency because we just got the report this week. Only 22% of workers who lost a job in 2022 got unemployment insurance. This is frightening because if we go into recession with that regular old state unemployment system, we're in big trouble. That is not enough of an economic stabilizer. So we have to think through a couple of things when we think through the people who are going to provide the personal services that are the backbone of the economy and that will be driven by the demographic shifts that we see taking place with the aging of the United States. We are a declining population going forward, and that will necessitate a better low-wage service sector. And it means reining in, these excesses. AI has the potential to be like word processing, in which it's very productivity enhancing. But the problem is we seem too frightened to confront them over their rent-seeking behavior and stopping them before they get so far that they actually do fundamental damage like they've done to taxis.
Okay, so we are, thank you, Bill. We're at the end of our time. So I'm going to end this session with a quick fire round question. What's your forecast for the unemployment rate by the end of the year?
Oh, God.
Diane.
I have a lot of scenarios right now. We're just doing scenario analysis. The low end is 4.5. The high end is over 5.5 to 6.
Nela?
I'm lower than Diane. I think it's going to be between 4 and 4.5.
Bill?
My hope is that despite the Fed's stupidity, the strength of the US economy is strong enough to overcome it, and we don't get unlucky. The Fed is they're betting everything on luck. So hopefully we are lucky, and I think that we should continue at this current level. We should be at worst somewhere around 3.8, 3.9. But again, I'm relying on the underlying strength, and I'm hoping that luck is on the side of the Federal Reserve because their brains are not.
Thank you. Thank you, our panelists, and thank you everyone for joining. Thank you.
Yeah, I hope they will.
Are they going to replace the water? Okay, thank you. Should I?
Based on where your mic is, and I'm on this side.
Okay.
Thank you. Sure, I like your tie.
Please.
Oh.
I work in manufacturing. I'm like, large objects move in, I'm getting out of the way.
Getting out of the way.
You good?
Trying not to fall off the stage at the same time. So I think we'll be in, I invited Bill. I think we'll be in much more consistent.
Oh. No, come on, it's more fun if we
When
don't
should I
agree on
start?
everything.
I know.
Okay, so how do I?
You will, okay.
Okay, you guys. Right, we'd love to get started with the next panel. I'm told I'm supposed to start to corral people and talk, and everybody will get back to their seats, so I hope that works. So welcome to the next session, which is very calmly called Assessing and Adapting to a New Trade Landscape. So we'll see how calm the conversation is. And could folks start to settle in? We have an academic on our panel. He might start to cold call on people. All right. Great, thank you, welcome. So our next session, as I said, is very calmly called Assessing and Adapting to a New Trade Landscape, much less of a feisty title compared to the previous panel, but we'll see how feisty this conversation gets. So my name is Mekala Krishnan. I'm a partner at the McKinsey Global Institute, which is McKinsey's business and economics research arm, where I lead a lot of our research on globalization and trade. And so I'm thrilled to have my fellow panelists here. One thing I joked about at the start of, maybe sadly, at the start of the pandemic and the years that followed, is that these times made everyone an armchair risk management professional and an armchair central banker. In recent years, I've also added an armchair trade economist. But I think I'm actually joined by people that are real trade economists on this panel. So we have Eswar Prasad, who is the Tolani Senior Professor of Trade Policy at Cornell, which is where I got my PhD as well. So you might get the first question because of that. And then we have Elaine Buckberg, who's the Chief Economist at General Motors. So wonderful to be speaking with both of you today. So this is, of course, a wild and interesting time, I think, for trade. We at the McKinsey Global Institute, as I said, have been doing a little bit of research. So just to contextualize this conversation a little bit, there are things that I think people have looked at in the global trade landscape and said, this suggests a whole range of evolution and change. We've seen, of course, rising geopolitical tensions. We've seen trade tensions even prior to that. We've seen the pandemic reveal some of the concentration that exists across global value chains. Some of the analysis that we've done suggests that concentration exists in virtually every sector in some way, shape, or form. In the electronics sector, for example, among the most concentrated products, China exports about 60% of the most concentrated products. In sectors like pharmaceuticals, the most concentrated products, there are pockets of concentration in regions like Europe. So this really exists across sectors.
We've also seen maybe the form of globalization change. So people have talked a lot about the rising importance of services trade. We heard that on some of yesterday's panels as well, the rising importance of digital trade. And so in many ways, there are things that are causing us to rethink the past era of globalization and wonder what the future of globalization will be. And that's what I hope to explore a little bit with the two panelists here. So maybe to start with that question, and Eswar, maybe starting with you first, what would you say are the top 2 or 3 trends in your mind as you look at this landscape of globalization, and what does that tell you about where we're headed?
From a Cornell alum, Mekala, I would have expected no less incisive a question than the one you have just posed. As one looks at the landscape of globalization, the sense that something is changing is in the air, but it's changing in a very interesting kind of way. As we look at global trade and financial flows, certainly financial flows took a hit after the global financial crisis, largely because banks began to pull back to their national borders. In the aftermath of the last shock that we had, the COVID shock, we've seen trade flows begin to decline as well, although they have come back up to some extent, but there is a plateauing out, at least, of trade flows around the world. But a more interesting phenomenon is that we are beginning to see trade flows, and particularly financial flows, begin to align more with geopolitical fragmentation that we are seeing in the world. Now, why is this happening? At some level, what we learned over the last few years is that companies around the world, including Elaine's, were able to exploit very lean, mean, and efficient supply chains. But we found in the last few years that these are potentially disruptible through a variety of shocks, such as geopolitical shocks, even more basic economic tensions, such as the US-China tensions, climate-related effects, and so on. So there are 2 potential responses to this. One is diversification. Diversification can make things a little less volatile, a little more stable, but at a greater expense. But at the same time, some of the sort of risks that I just mentioned may not necessarily be easily solvable through diversification. So what we're seeing is much more concentration, and concentration of a very specific sort, where countries are beginning to realign their foreign direct investment flows in particular in a way that is consistent with the geopolitical tendencies. In other words, we see more FDI flows among countries that are of similar geopolitical outlook. So what we are seeing is, in a sense, much more concentration, and the question is whether this is going to actually lead to more stability. My concern is that as we see more onshoring, friendshoring, which often means more regional concentration, that does not necessarily make companies less susceptible to some of these shocks, like climate shocks. Likewise, if you think about moving production to a country, that does reduce volatility, but it also has the effect of reducing overall output and economic welfare. And I think the biggest issue is where these 2 streams of thought collide, economics and geopolitics. If you think about the US-China tensions, for instance, economics used to be seen as a positive-sum game where both countries could potentially benefit from a relationship, even though there were some bumps along the way, while geopolitics was seen as a zero-sum game. So the one acted as a balance that smoothed out the other. Now we are seeing both economics and geopolitics being seen as zero-sum games, and that takes us, I think, to a much more dangerous and volatile place.
That's really interesting. I think both the combination, I was struck, especially as you said that you're already starting to see some of these shifts in the trade data versus speculation of these shifts. And so maybe actually that's a good segue, Elaine, to you and your answer to this question. What are the top trends, and how are you seeing it from the point of view of a manufacturing-oriented business?
I think my views will not be dissimilar, but I'll define them a little bit differently from what Eswar did. So the first one is that I think trade has become more politically and geopolitically driven, and perhaps this is various cuts being taken off a globalized trade world, but I'll point to 3 examples. One would be the Trump tariffs, many of which are still in place, especially with respect to China. I'll point to Russia's invasion of Ukraine and what that did to trade, especially in oil, right? A classic commodity that should be completely fungible other than the grades of the weight of the oil, but instead oil trade is increasingly I'll buy from Russia or I won't buy from Russia. So you bifurcated a commodity market. And we can talk about that more perhaps later. And then the third thing I would point to is the US imposing a variety of sanctions and export restrictions, limiting export of goods to China. These are all things where geopolitics is slicing away at trade that had arisen through perhaps more natural economic forces. The second thing I would point to is a really heightened awareness of the disruption that can arise to global trade and the kinds of, at GM with a large international supply chain, with a long-standing SWAT team to deal with supply chain disruptions, we're pretty good at an earthquake over there, a fire over there, kind of inventory buffers you need, the cascading challenges that arose through the pandemic with lockdowns that existed and restrictions that existed for extended periods, things that could be going through and happening in multiple places. So imagine something traveling through a supply chain and getting stuck in various places along the way. I think that that danger of cascading disruptions and the ability to manage that is more difficult. And I think, most crises involve either finding out the tails of the distribution are fatter than we thought, or that you got a really big draw out of the tails. And this is yet another one of those events where the magnitude of disruptions that can happen is greater than you thought. And the greater the distance, the harder it is to catch up because of either the transportation time or the incremental cost to catch up faster on transportation.
So maybe tying that also back to something Eswar said, one of the implications of rising risks, cascading risks, that is often discussed is, does that change the efficiency versus resiliency balance, right? Do companies need to start thinking about that differently? So I'm curious for your perspectives on that.
So first of all, I would say that we're always optimizing our supply chains, and we've done so for a long time. I think, again, there's lots of ways you can work through disruptions, and you have to decide the relative cost of your different solutions. How big are your inventory buffers? What's the expected cost if you have to put something on a plane? But I should start by saying that at GM in general, our theory of manufacturing supply chain is we build where we sell. We build in North America, largely for North America. We build in Asia, in China and Korea for Asia overwhelmingly. We build in South America for South America. And our supply chain is also primarily in the same region. And that's because it's simply easier to manage. So if you end up getting some part or component that has problems in it, and you need to have them, you need to send back a whole set of something, and you need them to redo it, well, the number of transportation disruptions that it can arise are lower. The speed of sending it back and getting it back again are lower. So that was kind of already in the fundamentals. But there are things that either the cost advantage is huge, or the technological quality advantage of something. There's the best producer of this lens in the world that would make the cut. I think the magnitude of disruptions is part of that re-optimization of thinking about even the supply chain for the same things and how we balance it, and again, how you weigh those costs. But one thing I'd like to point out is what we've done with microprocessors and how we've really changed the way we were sourcing them. So microprocessors are a form of chip. They're the most common chips in our vehicles. And for decades, we let our suppliers purchase the chips they needed that would go into the parts they were producing that would ultimately go into our vehicles. And that worked just fine for decades, until we ran into the chip shortage in 2021. And so what we announced in late 2021 is a new approach where we are contracting and partnering directly with 7 large chip makers. And with those chip makers, we will design and we will manufacture with them. We'll source directly and send the chips to our suppliers. In doing so, we're reducing by 95% the number of unique chips in our vehicles. Now, chips aren't fungible. The chip that does one thing doesn't do this other thing. The software is coded to the individual chip. So because of that non-fungibility, the matching process is hard. You simplify that matching process, but you also reduce the software coding, because we'll use the same chip over time and across things. And so there's a efficiency aspect to it, as well as a resilience aspect. And most of that supply chain will run through North America.
So in other words, it isn't always an efficiency resiliency trade-off, and there may be things that
Right,
get
and
you.
I mean, it's thinking about the problem completely differently. Oh, there's risk here. We want to be the big buyer versus outsource even the purchasing. And we're going to think about it in this more holistic way of not only the cost of it, but the cost of the engineering that accompanies it.
So Eswar, maybe building on that a little bit, do you see an expectation that disruptions will only rise going forward? How do you see risks evolving in supply chains going forward? And I know you used the word uncertainty before, but both in terms of magnitude of risks, nature of risks, cascading effects of risks. Any perspectives on that?
We do seem to be moving to a world where the sources of risks are rising, the relationships between these risks is rising, and the overall volatility is rising. So I gave you one example of where geopolitical and economic tensions might coincide and reinforce each other. And I think we're getting used to a world where climate-related risks are rising as well. So the question really is, how do you respond, and what is the environment in which you respond? I think Elaine's point about there not necessarily being an efficiency resilience trade-off is an interesting issue. And of course, it depends on what type of manufacturing one is speaking about. And the reality is that even if you want to rejigger supply chains, that's not easy to do on a dime. We hear about Apple wanting to shift some of its production away from China, and some of it is beginning to move to India, but it's not easy to find sources of intermediate goods, inputs, and the sort of labor you need at scale in order to make these changes. And especially at a time when financing conditions are tight, moving supply chains is costly. So that reduces the imperative to diversify as well. So I don't think this is something that is going to happen overnight or in the next year or two, but in the next 5 to 10 years, I think this is the lens through which practically every company is going to be seeing the landscape of risks and how they adapt to it.
So on that note, and also tying to one of the questions that has come in, one of the risks or the tensions is around geopolitics, as you've mentioned. And a question that is often raised is, are we going to be in a globalized trading system going forward, or is it going to be more regionally oriented trading blocks? A related question that has come in is to say, do we expect a serious thawing of China-US trade and political relations going forward? What needs to happen for that to take place? So both global versus regional trade, and then specifically US-China perspectives on that.
Sure. So
Ishwar's pleading the fifth.
if from this world, right, we evolved from 1989, we evolved away from the Warsaw Pact, Western trade blocs, and then all the other countries that were perhaps willing to trade with both. And we have evolved towards this increasingly globalized world. Now I think we're redeveloping some preferences in terms of who we do and don't like to trade with, especially for stuff that there may not be diversified sources and so on. But I also think you don't totally go back, right? Those relationships have been created. The boundaries won't be the same. But is there some tendency to prefer certain sources? Well, I mean, that's being created through law and administrative orders. I'm happy to get into much more detail about the EV supply chain and the Inflation Reduction Act, but there's an EV tax credit for consumer purchases of electric vehicles that is contingent on where the sources of that comes from. So maybe this is a good time for that. So in the Inflation Reduction Act, there are EV tax credits for consumer purchases of new electric vehicles, consumer purchases of used electric vehicles, and as well as commercial purchases. The consumer tax credit is up to $7,500, the same level as a previous one, but it's actually been split into two parts, each $3,750. Both of them are contingent on North American assembly of the vehicle. Half of that is focused on critical minerals. And those critical minerals are supposed to come from North America or a free trade agreement partner. And the percentage that has to come from North America or from a free trade agreement partner goes up every year. And if any comes from China, Russia, Iran, or other foreign entities of concern, it's a total knockout and you're ineligible. And that goes into effect in 24 and 25 respectively for the credit. For the battery component half of the credit, and they're independent, a vehicle can get one and not the other, there's a percentage of value that needs to come from North America. And so that directly establishes preferences and creates incentives to create a different supply chain. In addition, there are production tax credits for battery manufacturing in the US. There are grants for battery manufacturing and for critical mineral extraction and processing. There are other incentives for conversion of factories. So we're literally writing into law things that will say, it will be, you are financially incentivized to support source from here versus from there. And that is part of Senator Manchin's strong views that if we're going to be leaders in EVs, we can't be overly dependent on China as a source of the supply chain, given they already have a dominant position in sourcing, but especially processing a variety of battery raw materials, as well as things that go into magnets that are also important in EVs. And so he intentionally wanted to write in the legislation things that would make us not only develop that powerful capacity in EVs, but also develop it in the underlying supply chain.
So to build on, may I just build on Elaine's answer to broaden the perspective that this notion of industrial policy, once again, being on the table and it becoming pervasive, I think is a phenomenon we are seeing in multiple countries. Elaine referred to the Inflation Reduction Act, and then there is the CHIPS Act in the US, and in China you have the Made in China 2025 policy in tandem with this, what is called the dual circulation policy, which basically tries to encourage indigenous innovation and more domestic self-reliance while continuing to engage with the rest of the world on China's own terms. In India, we have the Make in India policy as well. And all of these are beginning to shift trade patterns. It's not just about bringing production back home, but also tilting trade and financial flows in a way that lines up with each country's geopolitical allies. So I think that is something we are beginning to see. As for the two big economies, the US and China, you said there was a specific question. I don't see an easy path to easing of tempers on both sides, particularly because at the moment, we see in the US there is a clear bipartisan consensus on being very tough on China, and there really isn't any political payoff to trying to smooth those relationships. If anything, it goes the other way. Once upon a time, again, there used to be countervailing forces that would keep this relationship in balance. You had a lot of American companies who saw China as a very important part of their supply chains, who saw China as a very important market. But I think there has been some degree of disillusionment among American manufacturers and in particular American financial firms about the sorts of access they're getting to China. So I think right now we are at a position where there is every incentive for both sides to, at least for the US, to ramp up the tensions on the political side, but none to ease them.
Okay, well, I appreciate you remembering that part of the question, Eswar. So one of the things you said earlier, and a few questions have come up related to that, Elaine, you also alluded to this a little bit, is with all of these incentives, with all of this rising tension, there is an expectation that going forward, trade flows will start to shift. And Eswar, you alluded to some idea that you're already starting to see this reflected in FDI. So one of the questions that has come in is, have you seen evidence of nearshoring, friendshoring, for example, to Mexico? We hear, of course, anecdotal stories of companies doing this, but to what extent are we actually starting to see this in statistics of either FDI or actual goods trade flows?
So the IMF, my former employer, has an interesting study that will be out as part of the World Economic Outlook 2 weeks from now, where they look at FDI flows using firm and industry level data, and they do find that there is a very strong shift. So typically FDI-like trade flows does tend to be concentrated among countries that have characteristics that are similar to yours and are also close to you, what we in economics call the geography variable. So there tends to be more trade among countries that have a similar language, that are very close to each other and so on. So you control for all of that, and then you look at whether the residual trade patterns can be shown to be affected by countries that are of similar geopolitical tendencies. And it turns out there is strong and increasingly strong evidence of that. So again, these are not patterns that shift on a dime, but the pattern in the data and the way things are evolving seems to be clear. Now, trade again has not shifted as much as FDI flows have. So FDI stocks again have not changed that much, but on the flow measure, we're beginning to see it. And on the trade, I suspect we will begin to see it increasingly. It's not just, countries that are geopolitical end, but one of the phenomena we've seen, of course, in the last couple of decades is that trade among emerging markets has increased a great deal, while trade among the advanced countries has increased a great deal. So there is an element there as well, because on the Russia issue, for instance, we've seen many emerging markets not being willing to line up with the US position. So we're seeing this reinforcement of economics and geopolitics once again.
So one of the things I always wonder,
Can I jump in on this one? Because there's a few things I want to say. I mean, first of all, moving supply chains is slow. So the fact that we don't see that much evidence, great that American, but I want to point to that Alberto Gomez at Citibanamex has done some nice work looking at industrial real estate vacancies in Mexico and how they're falling to zero. But there's moving supply chains, and then again, coming back to the vehicle and EV supply chain, we're building them out, and we're thinking about it, I think, differently than we have from other supply chains in the past. So we're talking about building supply chains that are secure, sustainable, scalable, and cost competitive. Now, those secure and sustainable words, I think, are new or refound ones. So sustainability, and from the environmental perspective, I think is a huge new focus for GM, certainly, but for other companies. And the secure word is probably one that hasn't been in the vocabulary talking about supply chains for decades, right? But then when we're thinking about how we're building out our EV supply chain, and this is something that well predates the Inflation Reduction Act, we are looking at achieving proximity, running it through North America, and running it also through allied countries. And so we are sourcing cobalt from Australia. We're sourcing lithium from California. We're processing certain rare earths and making batteries in Texas, and we're building the supply chain. We're partnering with companies to start extraction that wasn't necessarily happening, to move processing in North America. We're locating things to achieve efficiencies. They're heavy materials. Battery cells are heavy, and then battery packs are even heavier. So proximity and transportation matter a lot. And so we're really diversifying. And as we've done this, this isn't at the margins. We've secured all of our battery raw materials and other EV raw materials with binding agreements through 2025 fully for 1 million EVs produced in North America. And so that's one where on evolving things, you just start from a different place, from a different strategy, considering the current environment, as well as just the practicalities of moving things from one place to another and what that implies.
Yeah, no, that's an excellent point, Elaine. I feel like there's two nuances that are always lost in this debate. One is the point that you made, which is what we're doing for new supply chains and new capacity is a different conversation from shutting down old capacity and shifting old capacity, right? And it's much easier to think about new capacity differently. The other, which I'm curious to get either of your thoughts on, is I feel like we often talk about this in a blanket way, like all supply chains are going to be uniformly affected. And I think this is going to play out quite differently depending on the type of supply chain you're talking about, right? Automotive could be different from electronics, could be different from semiconductors. So any perspectives on just which supply chains you see as being more or less likely to move, more or less affected by these rising risks?
So first of all, if something's commoditized, right, you can source it from one place and easily switch to another. You can source it from multiple different places. And that's one way of securing your supply chain or making sure the resilience is to source from multiple different locations, right? That's up there with the basics of inventory and different transportation plans. But no, they're not all the same. And I think It depends also what kinds of, we all try to predict the future, but we respond more to things that actually happen. So what kinds of disruptions and challenges arose drive things more than hypothetical ones. And then, of course, legal incentives are powerful.
Yeah. So if you think about certain types of products like high-tech goods, I think the reality is that there are, production bases in Asia that are going to be very difficult to replicate at scale on the North American continent. But Elaine alluded to this. I think it's, as we think about newer technologies, say green technologies, the fact that we have government incentives at play here, in addition to the fact that investors, manufacturers see a much more uncertain landscape out there, will, I think, very significantly affect the way that new supply chains, especially in the new industries, new technologies, are shaping up.
So we've talked a lot about supply chains and goods trade. I'd like to pivot a little bit to services, data, digital, and maybe Eswar, finance, I guess, is the other one that you also mentioned. Any perspectives on that relative to goods trade and the outlook for other forms of global flows?
So finance is becoming a little more regionally concentrated as well when you think about specific parts of financial flows like foreign direct investment. But the reality right now is that, investors are looking for relatively good yield and relatively safe places to put their money. And if you think about geopolitical risk, again, as being a very important risk factor that affects returns and potentially also expropriation of assets, there is still a desire to look for places you can invest where essentially you can, reduce those components of risk in your portfolio. Now, having said that, the emerging markets still remain the countries which have much higher growth potential, and likewise the frontier economies. And I know you and your group have been doing a lot of interesting work on these issues. So for investors, it's going to be a tricky balance of trying to find yield in the spots of the world where there is yield to be had, at least in terms of growth potential, but where the domestic institutional and macroeconomic frameworks are stable enough that you can realize that potential. There is a great deal of other type of fragmentation going on, because we see in terms of the international payment systems right now, the US has been able to very effectively use the dominance of the dollar as a payment reserve currency and so on to use sanctions effectively. And the rest of the world has noticed, not just US rivals, but also traditional US allies like Europe, who've been a little unhappy about how the US has used its policies aggressively. I think we are moving to a world where payment systems such as China's cross-border interbank payment system can more directly communicate with the payment systems of other countries. So the dollar's role as a payment currency could perhaps decline, although I suspect that the roles of the other major currencies like the euro, yen, and so on is likely to decline even more. But as a reserve currency, I don't think we're going to see much of an effect. But I think there is a real desire in the rest of the world to somehow escape the grasp of the dollar. I don't think it's going to happen.
And then how do you think about services flows, data flows, digital flows? Can they take up the baton from maybe slightly stagnating goods flows going forward? Elaine?
Well, we also talked in when we spoke last week about technological developments and what they can imply. And while sitting in this conference, I thought, with respect to AI, I want to be very humble about my ability to predict the future and what we'll do, but some trade and services is driven by relative cost, right? And greater automation on the services side could, as well as on the good side and manufacturing side, can reduce labor differentials. And if we reduce our labor cost differentials, then that could actually reduce the efficiency and cost benefit of trade and actually be somewhat undermining for trade over a 5 to 10 year horizon for trade and services. I think that, again, I want to be humble about what will actually happen. It remains to be seen, but that seems to be a directional force.
Yeah, and one thing to complement what Elaine said is that as you look at services trade at one level, the diversification approach tends to work a little better when you look at services, because you don't need to set up brick and mortar operations necessarily. You don't necessarily need to expend huge sums of money rejiggering your supply chains. If you want to shift from call centers between the Philippines and India, that's a lot easier to do than restructuring manufacturing supply chains. So I think I haven't seen a good study of this yet, but looking at whether services supply chains are responding in a more agile manner to these risks that we've been speaking about would be interesting to see.
Okay, so idea for future research for the group. So all of this, of course, has implications for developing countries, right? So the historical pathway of growth is participation in trade and allowing that to be connected, allowing countries to be connected to the world. How do you see developing, you alluded to this a little bit with finance, but more broadly, how do you see developing countries participating in this future world of trade and benefiting from trade going forward?
So emerging market economies, which are now largely low to upper middle income countries, these are countries that have benefited a great deal from trade and finance. There is, of course, a big question about whether the net benefits were overall positive, especially when one looks at financial flows and the volatility that comes with them. But I've argued in some of my research that it's the things that come with the money that is really important. So if you think about China, China has a very high savings rate, but did use FDI as a conduit for technological managerial expertise, brought foreign investors into its market, as India did, in order to improve the depth and liquidity and corporate governance standards in those markets. And those have been very helpful in terms of these countries getting to a point where they can become more self-reliant. Now, there is a very large group of countries that haven't quite caught up yet. Many of them have participated in global integration largely through resource extraction, which has not necessarily been very good for their economic development. So these are countries that really need money. They also need these indirect or collateral benefits.
Examples of the types?
So if you think about frontier economies in Africa, for instance, many of these have very significant growth potential. If you take a country like Kenya, for instance, this is a country that has great potential, but they need better institutional frameworks, they need better financial markets and so on, and foreign capital can play a role here. And these countries, of course, are limited in terms of the size of their domestic markets as well. So the traditional pathway to growth, building a manufacturing base that generates high-wage jobs, that creates a middle class, I fear that low-income developing countries, as we see this balkanization of trade, could end up being the ones that suffer. So we might end up in a world where we have even greater inequality with the very rich countries being where they are, the middle-income countries now at a point where they can get by on their own and, in a sense, create blocks where they can feed off each other, and then a very large group of low-income countries that are left out.
So I'm way more optimistic, though, for emerging markets than Eswar. And I would point to a couple things. So first of all, we've talked about lots of geopolitical aspects of trade with China. Those are complications. But if you look at surveys done by the US-China Chamber of Commerce, and you look at other things, there are some reasons that supply chains were starting to move away from China that had to do with higher labor costs and higher real estate costs. So basically the cost advantage China had narrowed over time for certain things. And of course, there's other things where China, as it moved, it greatly expanded and advanced its educational levels, it becomes more productive at. But there are certain things where it just became a less cost efficient and therefore less attractive destination. And that means that for those sorts of things, there's a search for other sorts of markets that might be better to do that. And secondly, in a world where your advanced economies and your sort of higher level emerging markets, higher income emerging markets, your BRICS countries in many cases have slowing population growth and aging populations. Africa has the highest population growth and the youngest population of any, other relative of any part of the world, I believe, at this point. There are some countries that right now are poor and low income, but that actually have an opportunity that they could be capitalizing on as they become attractive for their labor force growth, and there are opportunities there, especially if they can raise educational achievement. And even in Africa, the tendency towards greater urbanization, which is more conducive than a rural system, towards being a supply chain, because you have to care about who can I attract to this plan and what are the logistics in and out of it. I would say it might be the best time for Africa in a long time.
So before the panel, Elaine and I had agreed to disagree on at least something to make it more interesting for you guys. But sadly, we in fact do agree on this because of the potential. I'm fully in concert with you, Elaine. The question is whether we might end up with these countries being able to take advantage of the potential, because I view trade and financial integration as being beneficial in terms of the pathway to realizing this potential, and that's what I fear. But yes, I agree that this is an opportunity, and I hope that there is a pathway for them to take this.
So what do they need to do to realize this potential?
So I think the key elements of being able to exploit the sort of opportunities that Elaine just very nicely elucidated are things like having better financial markets so that you have resources being directed to the most productive investments in a country. You know, foreign investors can help in this process, but if you don't have a good domestic financial system, the fact is that many of these countries actually have reasonable levels of domestic savings that they've not been able to harness effectively. And it's not just financial development in terms of getting better banks and so on. It's the basics of financial inclusion, because my long-held view has been that when you think about economic reforms of any sort, they are disruptive, they are costly. And if people in a country feel that it's the economic and political elites who benefit from those reforms, they're not going to support them. But once people get connected to a financial system, they feel more vested in the country's success. So I think the digital revolution is really helping this way. We are seeing the use of digital technologies that give people much easier access to the financial system. But you also need good institutional frameworks, because if you think about domestic or foreign investors looking at countries, in many of them, it's not so much constraints on the saving side, but it's on the investment side. Because you don't have good property rights, you don't have the rule of law, and you have endemic corruption. So I think these are not easy problems to solve, but I think financial markets, institutional frameworks, which in turn can lead to building up infrastructure of various sorts, those are key issues.
I saw you nodding, so I guess you're agreeing here.
I would point to the classic things: good governance, squashing corruption, quality of your infrastructure. How are you doing on the World Bank's, doing business index, which is a great index that goes across lots of different aspects of what it's like doing business. What's your infrastructure like? What's the education level of your workforce? And I mean, that may not be percentage that are college educated, but elementary school education, high school education, right? Just getting those basics right to make it a country in which you can operate.
So maybe one question that has come in, and Eswar, you alluded to this a little bit, so just a quick word on this before we start to close is, what is the answer for emerging markets that use dollar and euro denominated bonds, which are now experiencing a debt and currency crisis? What can they do?
Boy,
it's a big question in the next 3 minutes.
Tough one. The reality is that if you think about financing in the world, the dollar still remains the easiest funding currency, with the euro little fair distance behind. So the fact that many countries around the world are going to be exposed to US tightening cycles because that drives up the dollar, drives up interest rates and funding costs more broadly, that's a little hard to avoid. Now, the interesting thing is that during this period of turmoil, we've seen some emerging market countries like Turkey, Venezuela, and so on, which don't have great policies, large external financing needs, experiencing stress, but we haven't really seen a major blow up in the sense of a major balance of payments or banking crises. Again, there are countries like Ghana, which have a very large amount of foreign currency debt that are in pretty serious distress. And then, of course, there is a very large group of low-income countries that have large amounts of external debt. Those are the ones, again, that I really worry about, because without a clear path to debt restructuring at a time when access to new finance is limited and the cost of servicing the external existing borrowing is rising, it's an extraordinarily perilous time for them. So for them, I think we're going to have we're going to need a collective solution that involves private creditors, official, including multilateral creditors, and one very important bilateral creditor, which is China. So whether all of these can have a meeting of minds remains to be seen.
Okay, that was a good answer in a few minutes to a very, very heavy question, so thank you. Elaine, maybe one similar question for you. We've talked a little bit about climate risks, and a question has come in that is specific to climate risks in supply chains. How does your company or other companies that have large manufacturing footprints, how do you think about calculating your exposure to physical and transition risks? What types of things do you think are most important?
So we have agreed to science-based targets with the Science Based Targets Initiative that covers the emissions from from energy generated to support our plants, that's emissions that we control in our facilities, and that's also emissions for the scope 3 is emissions from our sold products. And so the vehicles that are still in service that are down the road, and we've set strong targets for all of those that you can find in our sustainability report. And I'm not going to be able to quote all the targets off the top of my head at this moment, and I apologize for that. But in addition, we are working with our suppliers as well, our suppliers who make components and parts, as well as the suppliers that are giving us our energy if we're not sourcing it directly. And some of our plants actually have, solar farms on the plant territory to provide some of our energy. So we're working with our suppliers to look at their carbon footprints. We've also said among our targets includes net zero emissions from our domestic plants by 2025, net zero emissions from our global operations by 2035. So we're targeting this in every way. And in terms of our sold vehicles, to give you a sense of some of our ambitions that we've put in the public domain to make sure we're holding us to, we aim to manufacture 1 million EVs in North America and 1 million EVs in China by 2025. So that's just 2 years away. That by 2030, the share of our US sales that are EVs will be 50%. And by 2035, that we'll have net zero emissions from our light duty vehicles.
We've talked a little bit both in that answer as well as in other questions about companies and how companies are adapting to this new trade landscape. What about the economics profession? What does the economics profession need to be thinking about differently in analyzing trade?
The first thing I want to say is we've got lots of natural experiments for the academics to study. Like, we're going to learn a lot because we've made a lot of abrupt changes and changes that are reversals in a really short period of time. And I found there was a paper, I wish I could remember the authors, that came out in 2019 that looked at 2016 tariffs on washing machines and dryers and what happened to prices. Well, not only did it get passed through to the washing machines, but the dryers weren't subject to the tariffs. But because washers and dryers had apparently sold at pretty comparable prices, the dryer prices went up too. So you got passed through of more than 100% on that one. So I mean, I just think there's a lot to study that will give us fresh information about the impact of different kinds of trade changes.
Yeah, some of the basic laws of economics still do hold. Tariffs do pass through. We don't get paid by China. I think, as Elaine said, we are seeing a lot of potential changes in the patterns of trade and trying to figure out how policies and also how the response of companies, investors, and so on, to the incentives they face, the risks they face can affect trade. I think those are interesting topics to study.
So we have a couple of minutes. Maybe my last and final question to you both. What would you say is one word that you would use to describe the future of trade, and why?
Evolving.
That's a great one. Fragmenting. Maybe.
Okay, and are you optimistic about where we're headed?
I am
Since they had a cop
uncertain.
out on the word, but.
You know, I feel like we're in such a dynamic period, not just for trade, but for so many things. You know, I think it's uncertain. I think, though, that we're facing new challenges. If I can speak from a U.S. perspective, we're facing a lot of challenges, but I think we're really being dynamic in also figuring out ways to address them while still achieving productivity and growth and technological development and sustainability. So in that way, I am optimistic.
Yeah, I do to offer a slight counterpoint. I do worry that this vision that we all had of, of a world enmeshed together by trade and strong trade and financial linkages that would work to everyone's benefit, that would, bring us all together and perhaps even allay political and geopolitical tensions. I fear that we're leaving that world aside for a world where we do see a lot more fragmentation with economic and geopolitical forces feeding off each other.
Well, thank you both. This has been a great and wide-ranging conversation. We've covered we've covered the evolving nature of trade, the fragmented nature of trade, the uncertain nature of trade, but some optimism, cautionary optimism remains. So thank you again.
At this time, we invite you all to please join us in the lobby for coffee and make your way to your breakout rooms. Again, please join us now in the lobby for coffee so we may flip the room and get ready for the lunch. Enjoy your afternoon.
Okay. Good to go? Okay, everyone. Can everyone hear me? I usually don't need a mic, but I don't know if anyone can hear me. Excellent. Thank you so much. Well, for those who don't know me, which should be pretty few at this point, my name is Dr. LaVon Henry, and I'm the chairman of the NABE Foundation. And also, you probably thought you got away without having to hear me twice this year. You're not that lucky, okay? Because I'm back doing what I do, soliciting for the foundation. And we'll get to that in a minute, but we also have, excuse me, some special guests who are joining us for this conference. And what I'd like to do is welcome the students of Villanova and Temple to our conference. Would you please stand? Okay. Where are you? Up, guys, up. Thank you. Now, I know they didn't have that far to come, it's from Philly, but they always are welcome to join us. And what I always remember is they were here a few years ago, or maybe it was even last year, and they had these great pictures with Dr. Yellen. It was Dr. Yellen, I believe. Okay, and she'll be back today, as you know. So I would also like to do a thank you to our NABE staff. And will you all please stand, NABE staff who are in the room. I'll tell you, I've never been able to understand how a organization with as few staff as NABE has, and I believe it's just 5, maybe 6, can turn out so many successful conferences and manage all the other things that NABE does. So not just from me, but from all the senior leadership of NABE, thank you so much, Tom, Tara, Michelle, Kirsten, Caitlin, and Nicole. Colette, I'm sorry. And anyone I may have missed. Thank you. Oh, Kristen, I'm sorry. I'd mispronounced it again. So, one more thing before we go live. I would also like to give you an update on where we stand with our fundraising. As you may recall, we're going for a target of 15,000, right? With 2 matches. So you may focus on the verb in that sentence. We are going, meaning we're not there yet. As of this morning, we are approximately a third of the way there. And we have a history of always making that target, making that bogey of 15. But we've learned that the QCR process was not as smooth as we had thought, okay? Technology is a great thing when it works. So we would like to encourage you, if you've had any trouble with the QCR process, to make your very generous donations and very much appreciated donations, to use the cards, okay? Just use the cards and we'll take care of the processing for you. Lovely Tara here can take care of getting you a card. And if there are no more here, you can just go up to the registration desk and fill out your donation there. Because students here, students yesterday, students around the room, they do dependent and they are dependent on it and they truly do appreciate it. That's a fair statement, students? Okay, thank you. So we have an agreement then, I guess. We're gonna not just make that 15, which will be doubled. We're going to do so much more. Thank you so much. And now I will not bother you again until I bother you again. I promise you, okay? But let me bring up to the stage Dr. Elaine Buckberg, the Chief Economist for GM, who's going to introduce a pretty important person. Thank you, everyone.
Thank you, Ron. Good afternoon, I'm Elaine Buckberg. And I so feel the energy in the room from the students and the NABE scholars who are the future of our profession here. And so let me just second Lavon's word. I already made my gift to NABE right before the conference. If you haven't done so, please take a minute to do so and use the old-fashioned paper and pen. So I'm thrilled to welcome Boston Fed President Susan Collins. She's president and CEO of the Federal Reserve Bank of Boston, and of course, she's a member of the FOMC. But she's no newcomer to the Fed system, having served on both the Detroit and Chicago boards of the Federal Reserve Bank of Chicago prior to her appointment. And prior to leading the Boston Fed, immediately before, she was the provost of the University of Michigan, which is the chief academic officer as well as the budget officer for the university. And before that, she was dean of the Gerald Ford School of Public Policy at the University of Michigan. And before entering these administrative roles, she had a 2-decade-long career at Harvard, at Georgetown, and also tied to Brookings. I'm proud to welcome to the NABE stage, Boston Fed President Susan Collins.
Thank you so much, Elaine. I really appreciate the kind words. Just wanted to start by saying, please excuse my raspy voice, not COVID, but I do have a bit of a cold, and so if I take frequent sips, my apologies. Good afternoon, everybody. I want to just say how delighted I am to be here with all of you, and I always love knowing that there's students in the audience, and so just especially delighted to know that we have NABE scholars and students here as well. I would like to also thank NABE for the invitation and all of you for being here. There are lots of important topics that we all care deeply about, and I think that bringing people together from across the country and a variety of different sectors and contexts is really important in terms of fostering the work that we all care deeply about. And I know that all of you use the tools and the insights of economics in order to support your own institutions and our economies more generally. And in my first year in this job, it is also something that I care deeply about, and I see it as an honor, but also a privilege and an opportunity to be a policymaker on the Federal Reserve. And I'm really very committed to taking an inclusive approach to foster our mission and serve the public. So before turning to a conversation with Elaine and taking some questions, I do want to share some initial remarks and perspectives from my first 9 months. I'll cover some obvious things: financial stability, monetary policy, the macroeconomy, but I'd also like to just touch briefly on some of the things that the Fed is actively engaged in that really get a lot less attention but are also important, including payments infrastructure and supporting economic resurgence in our communities across the districts and across the country. So, when you think of the economy, and I know all of you here in this room are thinking about economic issues all the time, I see recognizing the breadth of what the Fed does to support its mission as really valuable and important. I see that mission as supporting a vibrant, inclusive economy that works for all, not just one that works for some people. So before I jump in, I have to give the standard disclaimer. Clearly, the perspectives that I'm going to share are my own. I'm not speaking for any other Federal Reserve policymaker. Inflation does remain too high. Recent indicators reinforce my view that there is more work to do to bring inflation down to the 2% target that we associate with price stability. And I want to say why I see this as so important in a moment, but first let me just say a little bit about banks. Our banking system is strong and resilient. with well-capitalized institutions and ample liquidity. And the banking industry really plays a critical role in our economy, with banks of all sizes being important for meeting the savings and the credit needs of communities across our country. However, recent bank failures certainly underscore how difficulties in just a few institutions have the potential to undermine confidence and why that is so important. The Federal Reserve, in concert with the Treasury and FDIC, took decisive actions to strengthen the public's confidence in the US banking system and to protect the US economy. And I'll note that while these actions assisted depositors of the failed banks, shareholders and certain unsecured debtor holders were not protected, and the bank's senior management were removed. Vice Chair Bair, as you know, has a comprehensive review underway to determine what went wrong and what changes are needed. And we'll take what's learned to heart and strengthen practices in supervision and regulation accordingly. And that's consistent with our mission to ensure a safe, sound, and stable banking system supporting a healthy economy. The Federal Reserve, of course, continues to monitor financial conditions very closely and is prepared to use all of the tools at its disposal in keeping the banking system safe and sound. I'll turn now to monetary policy, and of course I want to be mindful that the challenges to financial stability and to credit conditions more generally do have implications for the macroeconomy and by extension for policy decisions as well. Last March, the Federal Open Market Committee, or FOMC, began raising interest rates to bring inflation down. But despite progress, as I've said, inflation does remain too high, and I see more work to restore price stability. So why is this inflation fight so important? The starting point for me, of course, is the Fed's dual mandate from Congress for price stability and maximum employment, representing strong, stable economic conditions that can benefit everyone. High inflation creates hardships for all, and particularly for those at the lower end of the income distribution who can least afford price increases, especially for essentials such as food, housing, transportation. Inflation also complicates investment and planning decisions for firms throughout our country. I, of course, lead the Fed's first district, which covers most of New England, and as I meet with constituents around that district, so many of them highlight the challenges that they face from inflation. Earlier this month, I was on a trip to Vermont and talked with a number of different constituents, and I heard from small business owners who are ending projects because of the cost increases. I heard from parents who are taking on additional jobs because of the rising prices for necessities. And I heard from people who are actually unable to accept very attractive job opportunities because the living costs were rising too quickly in the places where the jobs were located. Importantly as well, the two dimensions of the Fed's mandate, price stability and maximum employment, are intertwined. Low predictable inflation is an important precondition for maximum employment that's sustainable over time. Price stability is essential for an economy that functions well and for a strong labor market. Inflation, of course, reflects a gap between demand and supply, resulting in pressures that fuel wage and price increases. And in raising interest rates, the Fed intends to slow demand, cool a labor market that's still very hot, and bring demand and supply back into a sustainable alignment. Since March, the FOMC raised rates from near zero to the range of 4.75 to 5%. And after initial moves that were quite expeditious, recent increments have been small and deliberate, which in my view is appropriate as we approach a level that is sufficiently restrictive. The recent data show signs of more underlying strength in the economy, certainly than I anticipated, and the unemployment rate remains at near historic lows, with job growth remaining robust and spending indicators through September that were stronger than expected. This strength might reflect the fact that policy actually did not enter fully restrictive territory until the second half, relatively late in 2022, and it may simply be too soon to see the full effects of real activity. But it's also the case that special factors may have limited the impact of policy actions so far relative to our historical experience. On the household side, a sizable amount of excess savings accumulated during the pandemic, and a substantial amount, while certainly some of that has been depleted, a substantial amount remains. And although that's less evident at the lower income end of the income distribution, where there are signs of some stress emerging, that does continue to contribute to spending behavior. And on the firm side, balance sheets also remain quite strong, limiting the need for external finance. Sustained household and business spending and limited pickup of labor supply can help to explain why the labor market remains so robust and the strong activity indicators we've recently seen. And we just saw some GDP numbers for the fourth quarter of 2022. Those just came out, the final revision this morning. But there are also some emerging signs of slower labor demand. And in particular, a large portion of the recent strength in payrolls comes from sectors that were particularly hard hit early in the pandemic, such as leisure and accommodation and healthcare. And those sectors face significant hiring challenges during the recovery. So hiring in these sectors has been catching up to demand with a lag. And as this catching up process ends, I would expect more moderation in hiring, which should help to relieve the wage pressures. And in this context, I think it's really important to note that workers don't benefit from nominal wage gains that are eroded by too high inflation. What matters for workers are gains in real wages. So while we may be seeing some initial signs of wage moderation, more will be needed for sustained improvement in price inflation. And in determining whether inflation is moving towards target in a reasonable amount of time, I find it very informative to look separately at three key components. First, core goods price inflation has slowed, but a full pass-through of the supply chain improvements and some of the cost reductions, the lower input costs to goods prices, will take more time. Second, shelter price inflation remains quite high, but slowing growth in new rents with actual declines in some areas for rents and for house prices should feed through into lower shelter inflation in the coming quarters. However, the third component, services inflation excluding shelter, which tends to be the most closely tied to labor costs, that's the portion that remains particularly elevated and will require wage pressures to ease more. So in all, the challenge ahead lies in determining the level and the path of federal funds rate that can bring inflation back to target in a reasonable amount of time without undue labor market disruptions. And as I noted earlier, recent financial sector stress has added to this challenge by increasing the uncertainty around appropriate monetary policy. While the banking system does remain strong and resilient, recent developments will likely lead banks to take a somewhat more conservative outlook and to tighten lending standards, thus contributing to slowing the economy and reducing inflationary pressures. And these developments may partially offset the need for additional rate increases. While recognizing the heightened uncertainty, I do believe that staying the course with a 0.25% increase in the policy rate at last week's FOMC meeting was appropriate. And similarly, given the current information, I see the median federal funds rate path for 2023 that is in last week's Summary of Economic Projections, or SEP, from Fed policymakers as reasonably balancing the risk of monetary policy not being restrictive enough to bring inflation down and the risk that activity slows by more than is needed to address elevated price pressures. Similar to the SEP median, I currently anticipate some modest additional policy tightening and then holding through the end of the year. Of course, I'll be carefully watching a range of indicators, including data on inflation, spending, labor markets, and financial conditions. So overall, I continue to be what I call a realistic optimist. That means I'm well aware of the many risks and uncertainties that face our economy, and that does include the risk of a self-fulfilling loss of business and consumer confidence. However, I also have mentioned some reasons that I think provide a kind of good foundation to be optimistic that the economy may prove more resilient to tight financial conditions than it has in the past, including the business and household fundamentals that I've mentioned, which remain relatively strong. And so I do remain optimistic that there's a path to bringing down inflation without a significant economic downturn. As I mentioned at the outset, I want to touch just very briefly on some of the things the Fed does that get a lot less attention. And in my view, understanding the breadth of the Fed's work is important because, as I've said, I see the Fed's mission as fostering a vibrant, resilient, inclusive economy, and we do that in a much wider range of ways than most people recognize. So from monetary policy to economic research, financial stability efforts, community development activities, and initiatives related to payments, technology, and finance. And I'd be happy to elaborate during the conversation or in other venues, but for now I'll just mention two initiatives that show the breadth and the depth of the Boston Fed's commitment to a strong, inclusive economy with opportunities for all. First, the infrastructure for making and receiving payments is a foundation of everyone's economic lives. It's one of those kind of underpinnings that when things go well, we kind of don't think about, but it really is extremely important for that vibrancy. In today's world, people increasingly want quick and easy ways to make payments, and they want immediate access to those funds. On behalf of the Federal Reserve System, the Boston Fed has been leading the new real-time payment service referred to as FedNow. And we've announced that it will launch this July. And this infrastructure will provide access to instant payments for participating financial institutions and for their customers. The FedNow service will offer real economic benefits to the American public, who will be able to send and receive instant payments safely and efficiently through participating institutions, giving a lot more flexibility to manage money at any time of the day or night, 365 days a year. And we encourage financial institutions across the country to join the service so their customers can broadly enjoy the benefits of those instant payments. Second, for decades, we've studied gaps and disparities in economic outcomes. And this relates directly to our mandates from Congress, which includes maximum employment. Unemployment rates, for example, that are persistently higher by race or by place, as they have been for a long time, do not meet our mandate or our mission of a vibrant, inclusive economy. Such gaps reflect underutilization of our economy's labor resources and adversely affect productivity and prosperity. One effort that is proving important in this regard is the Boston Fed's Working Places program, which touches 30 urban and rural areas across New England. Research has shown that what we think of as the secret sauce in economic resurgence seems to be cross-sector collaboration, cross-sector collaborative leadership from local people working together to identify both issues and also solutions. The Fed's role in this work isn't funding. We provide a framework for convening and increasing that collaboration among the private sector, philanthropy, local organizations, civic and otherwise state governments and residents. The program supports efforts by local leaders to help their areas address challenges such as workforce development and affordable housing, and results are very promising. So I'll conclude just with a final observation. As I travel and hear about how people are experiencing our economy, I'm struck by the opportunities and strengths as well as the challenges. Hearing from a wide range of voices really rounds out the economic data that we assess and analyze. And I think deepens our understanding of what's working and what's not working as well in our economy. And it helps us, I think, make better decisions. My Fed colleagues and I will continue to prioritize this type of engagement and the collaborative work that we do, which I believe is really essential for our work. So with that, again, I'm delighted to be here, and I look forward to a conversation with Elaine.
President Collins, Susan, thank you so much for being here and your wide-ranging remarks on everything important, frankly, from inflation to the banking system to economic geography. and bringing up some left behind places. And I'm hoping that we can get to many of those. But let me just start by saying that you've been now president of the Boston Fed for about 9 months. And so tell us a little bit about your experience thus far. What has been a particular challenge, not that it's not a very challenging environment for the Fed, and what has been a particular, something you particularly valued or found satisfaction in?
Yeah, thank you. So first of all, delighted to have a conversation with you about a lot of interesting and important topics. As I said in my remarks, I really do see the role as an honor and a privilege. And a key, there are lots of things that are very satisfying, but as I mentioned, and the reason that I prioritized including a discussion of the breadth of what we do is that I find it, I would say, incredibly satisfying to recognize the many ways that that broader mission can be advanced. And so engaging with constituents across the First District of New England and working on initiatives that I think really can make a difference in people's lives, I find incredibly rewarding. And as you say, it is a challenging time. The 9 months has gone really quickly, no shortage of things to work on and to think about and to learn about. I think I think that we always have more to learn and ways to really improve what we do. And I think collaboration is important to that. So it is a challenging time. There's a lot that's unusual about the current context, just like there was a lot that was unusual about the pandemic recession, very different from prior contexts. And so learning in real time and figuring out what is the best way to balance all of those different considerations is certainly challenging. It's important work. And I'm glad that I have a strong set of colleagues, often with different views, around the FOMC table to be able to help make those decisions.
And it's fascinating to hear you say that, because I feel like within the district, community development is what I think often is what residents and businesses in a district see from a Fed. But the economics and finance community looks at interest rates and monetary policy and doesn't tend to focus on the important community development role of the banks. So thrilled to hear you're enjoying that. So what is, the number one question I think on this audience's mind is about the inflation outlook. So can you tell us a little bit about your inflation outlook and what do you see as the biggest risks to your outlook? Because we all have our most likely scenario, but I think understanding the risks is so important.
Yeah, absolutely. So let me start by just very quickly saying what is in the SEP, the Summary of Economic Projections. It just came out last week, and the median does give a sense of what the overall committee thinks, and in my view is quite similar to my outlook. And that has the inflation coming down by the end of the year to something in the range of 3.6%, perhaps by the end of 2024 to 2.5%, 2.6%, somewhere in there, and then close to the 2% target by 2025. I do think that that is a reasonable kind of baseline, but as you say, there are a lot of risks and uncertainties around that, and if anything, they have increased recently with some of the banking stresses that I talked about in my remarks. So not necessarily in order, but some of the risks that I think are worth focusing. And I will say, I and certainly others look at a wide range of different types of data, both quantitative and also qualitative. The conversations in the district asking people what they're seeing right now, the data often are looking at what happened last month or what happened in the past. Trying to understand what turning points might look like and what's happening right now is important. So some of the other risks, for a long time we've had concerns about what was going to happen with inflation expectations. If inflation expectations do become unanchored, that certainly makes it more difficult because it influences wage decisions and all kinds of other things. My read of the data, I feel relatively comfortable there, that they seem quite consistent with us bringing inflation down. there are a number of global factors that are also important. We were worried for a while about all of the supply conditions. They've come down substantially, but in some areas, there still are some supply constraints that are important. And, we've seen, we monitor global demands and the energy situation. And so there are a lot of risks that are associated there as well. And then I'll just end by noting the labor market. I think many of us had expected that labor markets would be a bit less cool or a bit less hot, that they would have cooled a bit at this point. And we're still seeing quite a bit of strength, and those wage pressures are key to an important part of the persistent inflation, as I mentioned in my remarks.
So I know you just touched on one of the audience questions, which was about, well, if we look at measured inflation, it's inherently backward looking. So what are leading indicators you look at? And I think, well, not quite stated that way, I think especially with regard to the path of future inflation.
Yeah, so I mean, again, I think there are a range of different indicators. One thing I'll say, which is not directly related to that, but I mean, typically I think we've thought of some of the key labor market indicators like hiring as being a coincident indicator. Recently, I actually think that's been a more lagging indicator because, as I mentioned, there are some key sectors that really struggled, and hiring has been a challenge because of labor supply and other reasons over time. And so we're actually aware that some things that might have been leading or lagging, we may need to interpret them a bit differently. And so looking more holistically at a wider range of labor market indicators, looking, as I said, unpacking inflation and looking at the components in a more granular way. And I will say also really trying to factor in some of the qualitative information that all of us learn from speaking with various constituents around our district. I would say all of it, and things that historically have been leading or lagging, we may not want to think about that way. So we're trying to think holistically about what the picture is that's being painted by all of the data we're receiving.
Great, thank you. And yeah, that's another thing that I feel like many audiences don't focus on enough, is the amount of outreach that the banks do to understand what's going on across entities in the district and really understand that. So I'd like to turn to financial and banking stress. And you did mention that you see the banking system as strong and well capitalized and resilient. How do Silicon Valley Bank's failure and the market fallout from that affect your economic outlook and your thinking about the correct policy stance?
So certainly the stresses that we saw earlier this month in the banking system have really focused attention in an appropriate way. And while certainly those, that industry was being carefully monitored, I would say that my own attention has increased in terms of the range of things that I look at, and an understanding of the importance of making sure that I also talk about that. I think it's important to recognize that, as I mentioned, all size banks, their strength is critical for a vibrant economy in the range of different types of communities, small, rural, as well as large urban settings. And so one of the consequences is just, I would say, an appropriate heightened attention. Again, not that there wasn't active monitoring and engagement in the banking system. I certainly don't want to suggest that. I would also just reiterate, as I mentioned very briefly in my remarks, that the things that we have seen are likely to make at least some banks a bit more conservative in terms of how they kind of make their decisions. And as they increase their own liquidity, that can cause a curtailing of credit to some degree and is likely to impact the financial conditions. If you had gone back to early March, or as I was looking at the data that was coming in, that was showing somewhat disappointing inflation indicators, that was showing real activity stronger than I was anticipating, I was planning to increase my submission to the SEP in terms of how much we would need to increase the federal funds rate to be sufficiently tight. And the context in the banking system has offset some of that. And so the SEP submission, my own view of what is an appropriate balance is very similar to where I was in December, despite that somewhat disappointing news in terms of inflation specifically. And so, in addition to, I would say, even expanding and heightening our attention, it also has, had an impact in terms of at least what I think is sufficiently tight for us to be successful in restoring price stability.
Great. And you talked about the banking system being resilient and strong and well capitalized, but the banking stress has also caused stress in financial markets, wider spreads, less issuance. So how do you currently assess broader financial stability and weigh it in your thinking about monetary policy?
So of course, financial stability is incredibly important. I think that the decisive actions that the Fed took in concert with the Treasury, with the FDIC, have been very important, and it will be, I think, important for us to continue reiterating that we will take the action needed to ensure that there is adequate liquidity in the system. And so, it certainly does influence the thinking in important ways, as it should. And certainly, if there was additional stress that had macroeconomic implications, that would influence the thinking about policy. And so the holistic assessment of data before we make decisions very much factors in those considerations.
I want to take a question from the audience related to banking, and to what extent are you concerned about commercial real estate? And could losses in commercial real estate further destabilize small and mid-sized banks?
I think it's a very important question. Certainly there are changes in how commercial real estate has evolved I won't say post-pandemic, it's moved into a different phase. I think of it as endemic. So certainly there are important reasons to be very focused on what's happening with commercial real estate. I will say that there was a heightened attention even pre-pandemic some years ago, recognizing that, not surprisingly, a number of small and medium banks do have a larger percentage of commercial real estate on their books. That's part of their role in helping to be a vibrant support for savings and credit within their communities. And so that had led the Fed to have some additional kind of scrutiny and focus in that area. I think that's appropriate, and there may be good reasons to revisit and to take a look at that. And so, again, it is something that there is appropriately attention to, and we'll continue to monitor.
Okay. And this is from the audience, but the duration and asset liability mismatch of SVB and other banks was some would perceive as not having had adequate supervisory focus, again, based on an audience question. And is the Fed at this point considering integrating additional capital markets-based risk measures into its supervision?
What I'll say about that is that there is a full review of what happened with the Silicon Valley Bank that's underway. It's being led by Vice Chair Bair. And I think it's essential that that be an unfettered review and that be comprehensive. The results will be public, and the commitment was to make them public by May 1st. And I think before we actually see what the details are in that review, it's really premature to say what might be appropriate things to consider, both on the supervision side and also on the regulation side. It will look through both sides of that, and it's very important. And I really welcome having that review underway.
So would it be fair to say that the review is not only a what happened, but what are the lessons and how should we incorporate this into our supervisory framework?
Absolutely, that is certainly the goal, to draw lessons, and again, I welcome that, and I think it's really important.
So let's turn to the fundamental tension between that often has to exist between the Fed's dual mandates of price stability and maximum employment. And when one is off, there's the potential for pressure on the other. And you echoed Chair Powell's frequent refrain that without price stability, we don't have an economy that works for anyone. And at the same time, while inflation has its cost, and you highlighted how it falls more heavily on more budget-constrained households, unemployment has cost too. And I think over time, we've become more focused on not just that someone lost a job and lost income, but their incomes don't necessarily recover to the level they were at prior to a spell of unemployment, and there are mental and physical health issues. So those are both like really big problems that hit households. How do you weigh those tensions and think about that?
Yeah, this is a really important issue and a really important question. I will say that on the unemployment side, the personal impact of unemployment, and we actually also know that unemployment, when unemployment rises, it tends to fall disproportionately on people of color, on people with less education. So it is not borne, it's borne disproportionately by some groups. And it's not just the individual impact, it's family impact, and also an impact on communities. And so I take really seriously a focus on what maximum employment means and slowing an economy, which I do expect will lead to some increase in unemployment. And I do think that without some increase in unemployment, it's going to be very difficult to bring wage inflation down in a way that's consistent with restoring price stability. So I think it's important to be clear about that, to recognize that, and not to do what we can not to have an undue disruption in labor markets. At the same time, as you mentioned, the extensive impact of inflation throughout our economy, when it's too high, I think actually, first of all, the breadth of that is substantial, and the implications over time, if it's not brought down, are really substantial. And so I do think the why is very important, which is one reason I started there in terms of why bringing inflation down is key, even though it is likely to mean, or I think it's very difficult to accomplish that without some increase in unemployment. So I take those things seriously. It's also why I mention, whenever I speak about this, that I really do see a pathway for bringing inflation down that doesn't require a substantial downturn. Some increase in unemployment, which is at historically low levels right now, I do think is going to be part of the path, but I don't think we need a significant downturn. And that's one of the reasons I worry about a self-fulfilling spiral that could actually make that more likely. And one of the reasons I'm so focused on the wide range of kinds of information, trying to make sure we don't miss the timing of when there are those inflection points. That's very difficult to do, and it's really important because those are the contexts in which you might go too far in terms of the policy tightening.
So this is the top question from the audience at the moment. Interest rates are sort of a blunt instrument for assessing inflation and unemployment. This is the questioner's phrasing. Should the Fed be given additional powers to affect the economy?
It is true that raising the inflation is a relatively blunt instrument. It is not a kind of focused, targeted instrument in the way that Congress can mandate. I think that the mandate is quite appropriate to have this broad set of goals, and I think that the tools are the appropriate ones for a central bank. I think some of the additional kinds of tools that I've heard at least some consider really are appropriately left to Congress or perhaps to the administration. And ideally, they work in concert in terms of trying to address different factors. I do believe that the toolkit that the Federal Reserve has will be successful in bringing inflation back down and restoring price stability.
Great. And this is probably from a market-based economist, but market-based expectations are saying that the Fed will cut interest rates by 100 basis points by the end of the year, despite the Fed sending completely different signals, including through the SEP. So does this raise concerns for you about market confidence in the Fed? And is there anything the Fed should be doing to adjust market expectations?
Let me say a couple of things about that. There have been a number of, and I've certainly followed central bank policy and markets for a while, maybe not quite as intently and closely as I have for the past 9 months, but during that period, there have been a number of times in which markets, and for example, the SEP or the way that I or some other colleagues have talked about our outlook for the path have diverged. And I think that there are always a range of views out there. I welcome having a range of views. I think that the breadth of discussion is important, and sometimes that can be underpinned by having different groups within the economy actually seeing things differently and looking at things differently. My current baseline, and again, I've mentioned that there are a number of risks, and so certainly things could evolve in a different way from what is my baseline. But I do think that unless we hold rates at a sufficiently tight level for some time, which I believe is likely to be through the end of 2023 before we start to bring them down, I think that that's what we're going to need to do in order to be successful with the fight against inflation. We do know that the lags are substantial, yes, in terms of the effects of tightening interest rates, of tightening financial conditions, working their way through the system. In particular, labor markets are one of the parts of the system that tend to be affected with a longer lag. So yes, it's true that we started raising rates back in March. And that seems like, wow, that's a year ago. There are some estimates that say that you should see after a year those effects, but it really wasn't until much later in the year that rates got to a level that was in restrictive territory and actually started to pull things back. Mortgage rates rose pretty quickly, and so you could see the effects in housing markets earlier, but I think some of the other effects really do take longer. And one of the lessons from history that I think is important is policy that doesn't stay the course is more likely to not get inflation under control than requiring the central bank to do even more and have a more significant disruption to labor markets in order to be successful. And I don't think that is the path that we want to go down.
And so you turn to the question of lags, and one of the hard things for the Fed is deciding when you've gone far enough, even if you aren't seeing those results. And I think the classic lessons had been up to 18 months, but there was an interesting paper out of the Kansas City Fed recently, and it's one paper from one author at the Kansas City Fed suggesting the lags are now about 12 months. What is your thinking about lags and how you incorporate that in your framework?
So I have seen that paper. As you mentioned, there's a large literature, and there has been for some time. Actually, within the range of estimates that is in the literature, that is in the range. It's maybe on the somewhat shorter side. But as I've said, there's some things that we're not really seeing yet. And so I think time will tell in terms of how long it actually takes. It's hard in real time to make an assessment of whether the lags have gotten shorter or not. I'm sure there'll be many, many studies that many of my economist friends and others, perhaps some in this room, will be doing after the fact. So it's possible that some channels have speeded up. I do think that reflects credibility, which is a good thing. Often the rates increase before we actually increase rates, and I think that is reflective of credibility as well. But what we're seeing, for example, in labor markets, to me, is suggestive that the lags remain important and that we're going to need to stay the course, recognizing that that means stay restrictive for some time.
And we have a similar question from the audience about credit tightening. And since it takes time for credit tightening and especially in response to recent events to happen and then to feed in the data, how does that impact your thinking about whether there should be rate hikes at the next meeting or whether to wait longer? How are you going to work through that?
Yeah, so my approach is to kind of review the full complement of data that's available at the time. And so it's premature for me at this stage to say what I think will be needed at the next meeting, because there's new data that will be coming out between now and then. That holistic review, which, as I've said, in addition to the statistical data, includes qualitative information. It also includes reviewing the results of a number of simulation exercises and forecasting exercises. From my perspective, you want to do that looking at lots of different models that make somewhat different assumptions and factoring all of those kinds of things into place. You know, we need to make the best decision, I believe, at the time, given the information that's available then, and that's holistic. It reflects all of those things that I've talked about in a variety of different ways. So one of the things that it certainly reflects, and I'm just kind of repeating something briefly that I already mentioned, is the recognition that if banks understandably want to adjust liquidity, that affects financial conditions. So there's a wide range of things in addition to what the Federal Reserve does with the federal funds rate that influence the financial conditions more broadly. And we want to be reviewing all of that and seeing what some of the responses are to it as we're making our decisions.
So I want to come back to more granular conditions on the ground as we close in our last few minutes. And with the turmoil of the COVID area, you know, economic geography changed. People moved out of large cities. Some of the biggest cities saw out-migration, and that helps some smaller towns and cities gain population because more remote work can be done. But we still have these left behind places. And you talked a little about the Boston Fed's Working Places Initiative, which awards grants to successful initiatives to lift opportunity. Can you tell us a little more about the lessons learned from that project so far?
Sure, I'm happy to do that. Thank you for asking about that. As I mentioned, it is one of the initiatives dear to my heart. I actually gave a speech more focused on this back in January. I do need to say explicitly, the Fed does not give out funds to different areas. The funding for the project comes from state and local governments, from philanthropy, there are now 30 sites across 5 states in New England. I will highlight 3 lessons. One is that really empowering local leaders to identify what they see for their community as being the key issues and what a strategy or set of strategies would be to address those issues really does seem to be effective. You know, I think what works in one place may not really work in another place, or the way that the specific challenges related to housing or related to helping youth to receive the kind of training that will provide opportunities for them may really be quite different. And so empowering local leaders is important. And so that the ideas and strategies come from localities. The other is having multiple people around the table. So it's not, one of the lessons is that just having 1 or 2 proactive leaders in a community is probably not enough to really drive change that is going to be sustainable and make a difference. And so the idea of having private sector leaders, civic leaders, state and local government, and philanthropy, and others all at the table crafting through, so what are the real issues that we think could make a difference in our community, and what strategies, and how are we going to actually follow through and implement them? So the first is having that be local. The second is really having it be collaborative across different sectors. And the third is the role that the Fed can play, especially now. I mean, we convened and catalyzed a lot of this, but one of the things that we are starting to do, and I'm quite excited about, is helping to do the cross-fertilization. So what are the lessons if you have 30 sites, you're learning in one place, how does that translate? What's similar or different in other places? And so how can we think about doing some more of this work at scale? You know, both rural areas are quite different, small cities are quite different, and there really are some that had vibrant manufacturing some years ago, and we know how many of them have been very challenged. There really are some that are seeing a resurgence, and I do think that we can learn from what's worked there and help other communities across our country to really have a resurgence as well.
Well, this has been fantastic, and I would love to keep going, but we're out of time. So Susan, President Collins, thank you so much for coming to NABE, for spending time, for taking questions from our audience.
Pleasure. Thank you so much.
Thank you.
Really enjoyed it.
Ladies and gentlemen, at this time, we ask that you make your way to our concurrent sessions and take your belongings with you as we'll be setting the room. We have 3 minutes to make it to our concurrent sessions. Please take your belongings with you. Thank you.
The breakouts are starting right away in the South American, federal, and congressional rooms down the hall. We do need to have this room back. They need to flip the room for the evening sessions. So we need to have everybody up and down the hall.
afternoon, everyone. Welcome back. Hello. I need some, yes. Perfect. Thank you so much. I'm Juhi Dhawan, macro strategist at Wellington Management, and excited to be moderator for the session which focuses on whether the US needs an industrial policy to compete in the new landscape. With me today are three excellent commentators in this field. Let me start first by introducing Mary Lovely, furthest from me today, senior fellow at the Peterson Institute and professor of economics previously at Syracuse University. Her research topics on China's foreign direct investment, as well as American outsourcing to low-income countries, will be especially relevant, I believe, to this discussion today. Next, we have Krishnan Silverberg, President and COO of the Business Roundtable. Krishnan works with more than 200 CEOs of America's leading companies to advocate sound economic policy. She's a former ambassador to the EU and has held positions at the IIF and is a former practitioner of law as well. Welcome, Krishnan. And last but not the least, Thomas Duesterberg is senior fellow at the Hudson Institute with prior experience at the Aspen Institute and has held positions at the US Department of Commerce as well. He's an expert on trade, manufacturing, economics, and foreign policy. So before we get started, I just want to level set to make sure everyone is familiar with what industrial policy is all about. So industrial policy refers to government efforts to support specific industries that are strategically important, often focused on all or specific parts of the manufacturing sector. In the aftermath of COVID, renewed focus on supply chain instability, vaccine nationalism, net zero transition, and geopolitical competition, there is renewed debate on the role of industrial policy. Market forces may not be sufficient to meet national security objectives, innovation needs, and intervention by some is considered desirable and by others necessary in order to ensure that there are no risks to strategic industries like semiconductors or the pharmaceutical industry. So what I thought we could do today is really just have a discussion based on some of these, with these experts on thinking about two main areas of legislation that have passed in the United States recently, the CHIPS Act, as well as the Inflation Reduction Act, both of which have very, very specific objectives in trying to ensure some protection as well as encourage certain types of activities back into the United States. So we're going to get started. As a reminder, please use the NABE app to send us questions, and I'll try to weave in as many as I can along the way. All right, so let's discuss, maybe Thomas, I'm going to start with you first, if I may. When you think about the CHIPS Act, the Inflation Reduction Act, specific intent on both of them, how do you think about industrial policy? Is it a good thing? Are there questions around it that you would think about when you think about it in a historical context? I'm going to give the floor over to you to kind of share some thoughts on this direction.
Okay, thanks to the National Association of Business Economists who featuring or welcoming a non-economist to this this conference. I'm going to take the negative side, the skeptical side on industrial policy writ large as a overall animating theme, if you will, for economic policy. I have three basic reasons why I take this this position. It's always a little bit hard to, in a limited amount of time, to get a lot of nuance in. But let me start with the three main reasons why I'm skeptical at a minimum about a broad-based industrial policy. First, and it's with fear and trembling that I make this argument to a group of economists, but in theory, from all the way from Adam Smith and Ricardo to Hayek and Friedman, the argument for market-based economies, non-subsidized economies, has been a strong one. Especially in the last 70 years, an open, non-subsidized or little subsidized, I think it's always have to have some nuance here, markets have bested the autarky which reigned in the 1930s and 1940s in the developed world. At a macro level, the historical examples, the modern historical examples of Japan and China, I think argue against generalized industrial policy. Both countries ended up with dismal capital output ratios, overproduction, and declining total factor of productivity. Capital output ratios belie the economic rationality of consistent national industrial policy, or more broadly, even in specific industries like steel and agriculture. In honor of one of my co-panelists here, I'm going to quote the president of the Peterson Institute, Adam Posen, who recently wrote about industrial policy. This is at a more granular micro level, if you will. He said, industrial policy is based on 4 profound analytic fallacies: that self-dealing is smart, self-sufficiency is attainable, that more subsidies are better, and that local production is what matters. Each of these assumptions is contradicted, he says, by more than 2 centuries of well-researched history, foreign economic policies, and their effects. The second major reason, and this applies especially, I think, to the United States, but also other practitioners, longer-term practitioners of industrial policy, is that it devolves quickly into politicized allocation of capital with frequently unrelated purposes, and in many cases, especially in modern China, massive overproduction. I worked in the US Congress for 10 years in the heyday of the neoliberal free trade order in the 1980s and early 1990s. And so I'm complicit in something sometimes referred to as log rolling. But the experience, I think, shows the readiness of favoritism and localism over both macroeconomic efficiency, earmarks, log rolling, unneeded infrastructure, proliferation of named research centers for every disease known to man are some of the historical results of a politicized allocation of capital at the national level. In contrast to the 60s and 70s, additionally, when the physical sciences, engineering, and math dominated federally funded research, which are all crucial to the industrial economy as the original purpose of the National Science Foundation noted, today's allocations are dominated by medical research and life science. These latter endeavors, which I have nothing against, but they are now twice those of the physical, engineering, and math sciences. A couple examples of industrial policy that I think are not good examples. Ethanol in the agriculture sector, the Jones Act in the commercial shipping sector. I would note too that in 1965, federal research was dominated by national security concerns. In 1965, and indeed throughout the 60s and 70s, but these are numbers for 1965, NASA, their research budget, or their total budget, was 0.75% of GDP. That of the DoD for research was 1.7% of GDP. That's about 4 times the total level of federal research now. Now, more contemporary, the CHIPS Act and the IRA are not well coordinated with overall policy. Are we going to subsidize rare earth and mineral production and processing to achieve the electric vehicle and renewable energy goals? Are we going to permit new mines, processing plants, and new high-power electric power lines? In the US, subsidized sectors almost inevitably get weighted down with often extraneous responsibilities which undercut their efficiency and dilute the focus on their ultimate goals. The early indicators of the rules for allocating the CHIPS Act and the IRA appear to require participants to pay for childcare, parental leave, give priority to organized workers throughout the value chain, share profits above a certain level with the government, restrict stock buybacks, and offer union-defined prevailing wages even for childcare providers. And also to provide families, what is quoted by Secretary Raimondo as family-sustaining benefits. All of these are good things, but if you weight down a policy designed to produce more semiconductors domestically, it goes against the purpose of that. Lobbyists are now trying to widen the scope of subsidies from CHIPS Act and IRA to augmented reality glasses and the underlying technology, advanced filtration technology used in heating and cooling, high-grade aluminum, advanced wireless technology, automobile electronics, etc. So it's hard to limit the scope once you get started. The third reason I'm highly dubious about industrial policy is that the US embrace of subsidies in the service of industrial policy leads to a cycle of competitive subsidization with our allies in Europe and the Pacific Rim, as well as with China and increasingly India. This race for subsidies and local production and the US change of position on related trade policy further undermines our attempts to modernize the World Trade Organization subsidy regime to counter Chinese mercantilism and ruins our credibility as a proponent of any semblance of a rules-based trading regime that has served the world well since the Second World War. So to wrap this up, to compete with China and perhaps less threatening and visible mercantilist economies around the world, I remain a proponent of improving the innovation ecosystem in the US by raising support for basic and applied research, a tax regime favorable for research and development, and improving our educational system to develop and retain needed human capital. I think we do need to ensure adequate national defense needs and well-functioning infrastructure, but all of this is a far step away from the sort of generalized industrial policy that we seem to be heading for.
All right. So I think we have one set of ideas here from Tom, and thank you for that. That's a good sense of where history has gone. But in particular, it also focuses on some of the areas that the government can or use in following industrial policies such as subsidies or export controls or thinking about R&D. And we can come back and debate later whether there are preferred measures of industrial policy that have tended to be more effective or others which have tended to be less effective. But I want to turn it now to Krishnan to hear how you are seeing the CHIPS Act work out in real time from a company standpoint, and what's the reaction from companies as they're trying to deal with some of the laws that are coming in place as we're learning about them. And then if you have any thoughts on the IRA as well, we'd love to hear that. Thank you.
Great. Well, thank you, Juhi. And before I get into the BRT's approach to chips, I just wanted to take a minute to reflect on some of the points Tom made, with which I largely agree. In light of the historical track record and a lot of the concerns he laid out, there is lots of reason for skepticism and caution in this area. And in particular, I want to reflect some agreement with the point he closed on, which is that the principal way the US government ought to be supporting a strong domestic manufacturing sector and a really solid industrial base is by working on the health of our economy broadly, by keeping a competitive tax system, sound regulation, investing in a world-class workforce, and all of those things. And I think there's a tremendous amount of work we need to do in those areas to get our house in order. The US is now one of 2 OECD's countries that doesn't allow immediate expensing for R&D. The Chinese, of course, are doubling down on incentives to bolster investments in research and development, and we've now abandoned a policy that we had for decades, bipartisan policy that was effective in helping to encourage investments in R&D. We're just on the heels of a multi-year debate about whether we're going to raise corporate taxes. President Biden just re-upped a proposal to make the US one of the least competitive tax jurisdictions in the OECD. We sit in about the middle right now, but the president's budget proposal would move us about and make us one of the worst. We have a lot of work we need to do in terms of our workforce. We have a workforce development system that works okay if you're trying to get a 4-year liberal arts degree, but works terribly if you're somebody who's trying to get the skills that you need for to participate in advanced manufacturing, the kind of repeat short-term training that workers will need in this economy. We could build on the success of the infrastructure bill from 2021 by passing permitting legislation, which would help get energy projects approved, ensuring we have more access to affordable, reliable energy, which is a real pain point for manufacturers. And that's all to say there's a long list of things we could do before we even get into the industrial policy debate and consider issues around potentially distortive policies. I also would like to agree with the point Tom made about one of the hazards of industrial policy. You know, the Commerce Department's implementation of chips is really giving a very good talking point to the people who share Tom's skepticism. As he mentioned, the Commerce Department has outlined a list of requirements for recipients of those acts. One of them, as an example, is that you provide on-site childcare. And the Commerce Department has said, in essence, you won't be able to get the workers you need for these fabs if you don't offer on-site childcare. Now, they may be right about that, I don't know. But it's essentially Commerce Department bureaucrats telling large employers, we know better than you do what kinds of compensation and benefits you need to use to employ workers. And so it's another talking point that industrial policy can be a foot in the door for bureaucratic micromanagement. Okay, so I've now conceded a lot of your points. I want to issue a giant caveat, a big but on the end of that, which is that having agreed with Tom on all those points, I think the China question is going to create some hard calls, even for those of us with a free market orientation, and I certainly put Business Roundtable in that category. Policymakers who are debating industrial policy today are grappling with a concern that was not a factor in the industrial policy debates of the 80s, for example, which is the emergence of a strategic rival with whom we have a deeply interconnected economy. And so rising tensions with China, China's willingness to use coercive economic policies to pursue geopolitical aims, and of course, the heightened risk of a geopolitical event in the region really need to make us ask about, look and consider closely the reliability of supply chains in key areas. And that was certainly a factor in the CHIPS debate. There were a lot of supporters of the legislation who were focused on traditional industrial policy concerns. Basically, can we get some, good domestic manufacturing jobs out of this? But one factor that was decisive, at least among a lot of Republicans, was the need to invest in some domestic capacity as a hedge against the risk of conflict over Taiwan. And I think that same concern about the risk of coercion or about vulnerabilities is going to apply to some other key inputs to the broader economy. In addition to semiconductors, the Biden administration has highlighted risks around large capacity batteries, critical minerals, as Tom was mentioning, pharmaceuticals. I think there may be a case, to answer your question, for direct investment and targeted incentives to spur domestic mining, refinement, and processing of critical minerals. And I think we'd strongly support some permitting reforms to help on that as well. I don't think any of that needs to come at the expense of working with allies and partners to build greater capacity. I think that true resilience will come from having flexibility and diversification and surge capacities and a lot of things that are hard to do at a large scale if you're just working domestically. And I think with that, I will hand it back to you, Juhi.
Thank you for that. There's so many more nuances that I want to pull out of this, but let me first hand the floor over to Mary to see how you're viewing this. I know Peterson's done a lot of tremendous work on this. You yourself are very focused on the relationship with China, which Krishnan mentioned, and thinking about the CHIPS Act in the context of trade policy, the IRA. Where do you land in thinking about the choices the administration is making and the future direction of industrial policy in the United States?
Great, thank you. And thanks to my fellow panelists for setting the stage so nicely. I guess I want to begin by thinking about 3 reasons for using industrial policy that are relevant to today's discussion. And I think they're all focusing around various forms of market failure. So we can believe in markets, but also believe that government has a role to play in guiding the markets. That has certainly been the US position. US may have taken more of a hands-off approach than other countries, but the government's always been present in terms of R&D, even as simply through the defense budget. So we have a long history of using the government to guide the economy. It seems like we're increasing the extent to which the government plays that role, but I think it's coming from 3 things that the American public wants addressed. One is climate change, and there's reason to believe that due to coordination failures can't read my own handwriting here. Just the inability of firms, network effect. So for example, would I buy an EV? Well, I drive between here and Syracuse, New York, and if there's not charging stations along the way, and if the vehicle won't go 300 miles, it's a non-starter for me. I just can't do it. So we see that there's these issues having to do with coordination failure where the government could play a useful role. The other is security, and security is a broad term, but it has become a bit of a short term for China, which Krista mentioned. And here we see what we believe is now an overdependence on China. And moving away from that is going to be extremely difficult. So we can come back to that. And last is a sense that the market hasn't delivered enough broad-based economic well-being for Americans. It's not clear that this is necessarily a problem that's best attacked through industrial policy, but I think many will look at the way jobs have moved away from the United States, what's happened in individual regions in the United States, and asked, is there something that the government can do here? So I think there's 3 big pressures on politicians right now, on policymakers, some of which would clearly, in the formal economics literature, suggest that some role for government intervention, such as to overcome coordination failure, would be needed. Now, having said all that, I want to throw in a huge cautionary note. Some of these other notes have already been mentioned by my fellow panelists, but I really want to focus on the international sector. One of the things I'm worried about is how do we make a market for subsidized or friend-shored? And friend-shoring is a word that I believe goes back to, Secretary Yellen is using it, and she's coming up next, but I believe perhaps her colleague, Secretary Raimondo, actually used it first. It suggests that we are going to have blocks, trading blocks, and we'll have a group of friends, and the US government has described this differently as like-minded countries or democracies, or those who share our concerns. But I think in a large sense, it means not China. And we see the government actually actively trying to create these blocks, first through the Indo-Pacific Economic Framework, which has been recently being negotiated, part of it in Bali, and now moving that into ongoing discussions with Latin America. So there's an important international aspect to this, because we need to sell these goods that are going to come through supply chains, which quite frankly are alternatives to China, but are not going to be, frankly, competitive with China. China has too much of a head start. So what does that mean for the US? I think it means market restricting actions. And we've already seen under the Trump administration very high tariffs on China. We have anti-dumping duties, countervailing duties. We've seen this very much in solar, even though there really, to this day, is no good alternative to China on certain solar products and parts of the solar supply chain, an industry that's crucial to our desire to increase renewables. So we're going to see it in terms of trade policy. We can see it in terms of increases in barriers to suppliers who are not part of our friend group, however we end up defining that. We're going to see it in another way, which is through local content, so-called Buy America. And we absolutely saw that in the Inflation Reduction Act. It has led the administration to have to backtrack because our friends, which are not included in the local content, were very upset. And so they've had to backtrack with the European Union. We had an agreement this week with Japan to backtrack on that. So I think this leads to the concern that was expressed by Adam Posen recently in Foreign Policy, which is we're going to lose allies. We're discussing this in East Asia. If one of our asks is to build out China, the East Asian countries cannot meet that. They will not meet that. And so we will lose hearts and minds that way. It'll make US manufacturers less competitive. And here I'm particularly concerned about SMEs because the large manufacturers honestly have the flexibility to find alternative routes. They have market share. They can choose to absorb some of the cost increases. But many medium-sized industry and companies in the US are really only import-only companies. They're importing intermediates that they use to produce a product for the American market, and then they have to compete against imported products. So you're really tying one hand behind their back. And the last is it could make us less secure. How can it make us less secure? Because we'll fool ourselves into thinking that just because we're not importing things directly from China, well, actually we're not tied to China, but of course we're tied to China. China is deeply involved in every single supply chain. That's why the Commerce Department now is asking US companies to go through to the fifth tier to figure out where it is, but even their companies say there is no alternatives. So this is a large set of things saying a lot more thought in industrial policy has to be tied to our trade policy. Right now we have a US trade rep who sees the last 20 years of trade policy as the problem. What that means is that she sees US openness as the problem. I personally don't see that as the problem. I see it as part of the solution. Now, just as a contrary, you would say, well, what about plant closures, et cetera? I think a lot of that, frankly, has been due to technological change. I know that sounds trite, but a lot of the outsourcing that we saw in an industry my sister was involved in electronics had to do with companies being able to offshore the industry. And of course, we witnessed the tremendous growth of the industry. What do I mean by that? Could there be an Apple without a China? Well, we're going to see because they're trying to move into India and other places. But we have to admit the tremendous amount of prosperity that all of us have gained through the tremendous growth of Apple, through TIAA-CREF or through Wellington recommended funds. So there was a tremendous amount of prosperity there. The problem was that prosperity wasn't widely shared. And I think that industrial policies, in answer to that question, would be far, far down the list of things that most economists would recommend. So I'll leave it there.
Thank you, Mary. I'm going to ask another question from my side, but I also am hoping someone can help me out. There's a password lock on this iPad, so I do really want to get to your questions. Someone's going to come and help me with that. In the meantime, I will take the prerogative to pose a subsequent question, which is, each of you has been quite clear in saying, this is a dual-edged sword. There are some benefits, but there really needs to be a balance in thinking through very carefully what it is that we want from industrial policy. From your experience, are some tools, have they yielded better results historically than others? So for instance, is R&D investment a better idea, or is infrastructure development a better idea than, say, subsidies or controls? Open to hearing thoughts on that.
I could start on one, which I hope my fellow panelists will pick up on, which is workforce development. There are jobs. We know that the unemployment rate is low. Secretary Yellen's here. We can ask her what's going to happen with inflation and other things that are being caused by such a tight labor market. The question is, are the jobs in the right places, and are they good jobs, right? And so now they're trying to, the administration has been trying to mandate good jobs, goods with childcare, jobs with certain types of wages. How do we as a free economy grow good jobs? Well, one of the things is upskilling, and there's a lot of pushback on that, but it's really important. So my daughter's getting married, and she's marrying a guy who's now a welder. But to become a welder, he had to go to welding academy. You don't just become a welder. You don't just start burning things, okay? To become a welder, it costs you anywhere from $13,000 to $15,000 for your tuition. And during that time, you're not going to be working, because that's full time if you do it 6 months, okay? You'll get a good job at the end with benefits and with retirement. How do you live? Most of these kids today are not coming from wealthy families, right? Wealthy families have lots of ways to make sure the world is nice for their children, including me. But, you know, how do you get them to have the support they need? Now, there are some programs here in the DMV. I know of some. I'm sure there's some nationally. But they're really for people who are really have no assets. And there's a middle. There's other people who have gone to high school, done well, but don't want to go to college, want these types of jobs. How do we support them? I think you mentioned this. This is really important. How do we create the people who will take care of the machines in the semiconductor fabs? Because, you know, semiconductors aren't made by hand. They're made by machines. So this is where we really need the workforce development. It goes into things like a reasonable immigration policy. We need the workers to create the new workforce. I would focus on the workers. And that means not just their education, also making sure that they're healthy, that their teeth are fine, all these other things. How do we do that? You know, we've got some good starts. We've got some programs that are working. We have health exchanges now, which have offered health insurance to people who previously didn't have it, provide generous subsidies so that my future son-in-law has had health insurance during this time, something he wouldn't have had. We need to be investing in people who are 20, 30 years old and are the future of the American labor force.
Anyone else want to go? Or
Well,
I have a long list of questions here.
Okay, I might
Tom,
just
go for it.
quickly, I agree with Mary, and I recall 20 years ago, my associate, when I was at the Manufacturers Alliance, her son, after high school, became a welder. This was 20 years ago. Went to work for local utility, starting salary at $90,000 a year.
Oh my.
You know, and good benefits. I would just, one thing I talked a little bit about was national commitment to basic research, and I referenced the NASA program. The Apollo program was why we had, you know, 0.75% of GDP going into, you know, physical sciences. It was a successful program, paid lots of benefits, you know, commercial aviation, semiconductors was a spinoff of that, modern computing, a spinoff of that. So that was effective. People cite sometimes the COVID development program here as a very concentrated, very specific type of direction of resources. I have a quote here that I was going to use. My basic point about industrial policy is it's very hard to limit it for lots of reasons, political being the most prominent. But Wall Street Journal, I think he's still with the Wall Street Journal, columnist Greg Ip said the lesson of industrial policy is most likely to succeed when the goal is narrowly defined and leverages private sector initiatives. It is less likely to succeed when it is used to solve multiple social goals disconnected from the industry's economic viability. And I think history shows that that's an accurate observation. It's just very hard to limit, and you know, even in a democracy like ours, you all know how Congress works in this country, and you ought to see how it works in China.
I'll just mention quickly that I totally agree with Mary on the need to rethink our workforce system. One, to make it more flexible, give workers more power and flexibility to get the training they need, make sure it's tied to actual demands of the economy, to jobs that exist, and particularly to support short-term training. I don't think of those things as industrial policy, or I don't think of them at least as any form of industrial policy that would implicate the kinds of downsides that Tom mentioned. I think of industrial policy as really the more targeted investment in a particular sector, usually to drive some kind of domestic, activity, usually manufacturing. And to me, the typical models being either some subsidy or maybe some, tariffs or import restrictions. And when you think about those kind of traditional tools, to me, actually, there is a better track record on the subsidy side than there is on the trade measures side, which is another reason why I think the CHIPS model has some downsides, but is a much better than some of the traditional options.
That's very helpful, because I do think when I think about this globally, a lot of conversations are also taking place in Europe and in Japan, as a lot of countries are reinvigorating industrial policy. And I think the more attachments there are to these policies, in terms of the number of objectives they're trying to achieve, the harder it is to harness and bring back sort of the return on these policies, right? So I think that's an excellent point. All right, so let's get to the question of, can one view industrial policy as government investment, taking the downside risk off of the table, where markets are inefficient or failures, and getting the upside through welfare improvement for its citizens?
I'm all happy to
All right,
start
go
on
for
this
it.
one. As I mentioned, to me, as I mentioned before, to me, the strongest case on chips was this reliability on a critical, whether we had in this critical area reliable supply chain. And so the chips was really meant to ensure that we have sufficient capacity basically at the end of this decade, which is when presumably the Taiwan risk gets higher, and also global demand for semiconductors is higher. In the meantime, we've seen what looks like a glut, and I think Micron made some announcement yesterday, you would know better, but that they're scaling back on production a lot to address kind of short-term market issues. Some people would say, oh, that means, look, chips was unnecessary, the global semiconductor shortage is already resolved. But to me, when you look at this longer-term reliability of supply chain question, the short-term ups and downs are not going to tell us very much about whether we were right on that question, whether we were right on the hedging against major geopolitical risk. And in that sense, the government taking away, keeping companies an incentive to continue investing despite the short-term up and downs will be really important.
Anyone else want to chime in? I have plenty of other questions otherwise.
I just think it's always a problem when you start socializing risks. It creates a problem of moral hazard. We're seeing that time and time again in the banking sector, amongst other sectors. In China, again, I keep throwing off these references to China, but they have socialized risk across the economy. That's the way their economy works. Massive overproduction in sector after sector, totally over-leveraged. So I just think it's a problem that once you start going down that path, it creates its own problems, and it's hard to stop.
I guess I would add that, there are some risks that are private risks and some risks that are public risks. We don't ask private firms to supply our national security, for example. So I think Kristen's argument in favor of the CHIPS Act was that this is basically a national security imperative. And I think many people would agree with that. including myself, when you look at the concentration in one tiny little part of the world, you think this really can't be optimal, right? I mean, just doesn't even pass the smell test. But the danger, I think, is that you're going to see national security issues. I mean, you're going to see enemies everywhere. This is what we're at risk right now. And, you know, we have calls to put tariffs on everything from China. We have calls to force companies to divest in ways that actually hurt profits for Americans. So I think we have to think real hard about what is the social dimension, what is the national, you know, the public welfare problem that we're trying to solve by socializing risk, rather than just saying that we don't always socialize risk, or we do. It really depends. I think the problem right now is that we're beginning to see boogeymen in the closet, when that is not the way that America usually performs well. We're the strongest country in the world, we remain the strongest country in the world. We need to continue to uphold our values. By that, I also mean markets and open trade. And here I would say that as a global leader, the US is falling back. We are seeing increased use of local content and protectionism everywhere. Canada just passed a budget that has subsidies in it. They're debating whether that is truly Canadian, right? EU has passed its own form of the CHIPS Act. India has raised tariffs dramatically. It's beginning to put $20 billion on to subsidize its own industries. And it has also started a program of progressive local content, increasing local content as they move up the value chain. Why? Because US leadership is absent. And in fact, there are many, I think, who would embrace that and say, yeah, everybody should subsidize because this is what we need. It's not clear where that's going to go. It's not clear why cooperation and having, you know, taking advantage of comparative advantage are still not important issues for the United States to be talking about on the international stage as well as in our own domestic policy.
All right, we're going to get to 2 more, maybe 3 more if we go really quickly through these. Is the push for an industrial policy linked to the offsetting of the hollowing out of the manufacturing sector that's been talked about? Yes?
I think clearly yes.
Yes. Yes. So with that reference in mind, do you think that the basic R&D success in the past all stemmed from a specific goal such as the moon landing? Is there a modern parallel that we could consider?
Well, I mean, the vaccine is a modern parallel, right? But there's a tremendous amount of R&D that's been done, not only by American companies in America, but around the world, that has led to advances in, you know, rather prosaic products that make your life better every day. You know, people like to laugh at things like Procter & Gamble, but you know what? US baby diapers are darn good. So I think that, you know, we need to recognize that there are some things where we need to have governments involved with R&D and also incentivize private sector R&D, which is what Krishnan was talking about in terms of, you know, US regulatory and tax policy.
Just to follow up on that, I think Mary's right. The vaccine example is a really good one. And that one was interesting because the US government was very flexible. I take it that the vaccine supply chains are very global, and the US government was very flexible about what it would take to get. So it didn't have the issues that she just raised around the EV tax credit and the domestic assembly and domestic content requirements. They basically said, just get us some vaccines. And so anyway, and if you are attempting the moonshot approach, if it's the kind of, it's a critical imperative, you've got to get it done, you really want to avoid weighting it down, which I think was the point Tom was making about chips too. You don't want to saddle it with a bunch of unrelated requirements.
So in that context, which industries are most appropriate for industrial policy, which are most likely to be missed? There are no easy questions with this audience.
Well, the question is getting harder to answer because, I mean, I agree with my the other panelists about the primacy of national security. How do you define national security? And as in the digital age, lots of things like we wouldn't have thought 10 years ago, much less 20 years ago, have a relationship to national security. I mean, space technology, wireless, lasers, these are all important to national security. When I've tried to grapple with the issues, to my mind, the Department of the Defense has done a reasonably good job over the long course of time in being very specific about what they think they need in terms of technology and where they don't want to be dependent on outside sources. So, and they're constrained by the amount of money that they can spend. So they're pretty discriminating. That's is pretty much the best answer I can think of.
I think we had a pretty good list. I mean, President Biden early on had an executive order on supply chains that listed a number of industries, which I think Kristen listed earlier, and I think that that's good. The question is, how do we shore those up? One thing we did learn during the pandemic is that no one supply chain is the same as the other. So there isn't going to be one template for government involvement in these sectors. And the other thing, of course, to remember is that supply chains are run by the private sector. So the private sector is absolutely going to have to be part of the conversation and the solution.
Maybe last question on the China policy, because I feel like we've spent a fair bit on it. So Biden's China policy has been characterized as selective decoupling with a focus on foundational technologies. Some China hawks argue for complete decoupling. Do you favor decoupling in any form? And if so, to what degree?
I'm happy. I think it's clear that we will be doing selective decoupling, that there's a bunch of, one is kind of advanced technologies on which we will not want to be sharing technology with China, and there are some issues on which we're going to want to diversify our supply chains to have kind of more flexibility. So I think that's clear. I think it's really important that we make sure it is in fact strategic. There's a lot of trade we do with China that does not involve sensitive issues and is absolutely in our interest economically. And trying to separate our economies entirely, sort of, Russia style, I think would really damage the U.S. economy over the long term.
My view is that when this question is asked, it's always asked, do we want to decouple? And the real question is, why does China want to decouple? Because clearly it's part of their national policy to decouple, become self-sufficient, autarkic, whatever you want to call it. And so that is constraining on us in many ways. I do agree with Kristen, though. We need to be very selective about how we think about this. I mean, we don't want to be dependent on semiconductors. We don't want to be dependent on the critical minerals that go into renewable technologies, including electric vehicles, but also solar cells. So we want to do what we can to. In my view, I again emphasize doing the basic research. And I would also agree with Mary that working with our allies is vastly preferable to trying to go it alone. And things like critical minerals, there are plenty of them in, amongst our allies, Australia, Canada, and others. So that's.
Yeah, I think the U.S. could be a leader here, but we're not now. I think Ursula von der Leyen of the European Union gave a speech yesterday talking about de-risking, not decoupling. And I think there is a difference. And I think that we will be de-risking, but we talk like we're decoupling. President Biden has already said we're not decoupling, but then we have administration officials going around the world talking kind of open-endedly about we want to change our supply chains, we only want secure supply chains working with like-minded, well, where does that end? How narrowly are we gonna draw the world? I think a good place to start, and this won't be popular for a lot of people, is to reform the Trump-era trade tariffs. I think it's actually quite regressive and bad policy to have tariffs on children's shoes and boots and things that have no absolute strategic purpose. Human rights are one thing. We have the Uyghur Act for a reason. We're enforcing it. That's important. But there's lots of other ways in which we can signal to China, we're pulling back on these areas. We're transparent. That would allow the private sector to know where the US is going, and then incentivize in the investment that is needed to actually make the change, to pull supply chains out. If we're sort of vague and it covers everything, how do you know where to ask your subcontractors to move or to look for new subcontractors? So I think we need to be strategic, yes, and that means narrowing our focus and being much more transparent about how we're going to get what we want.
We can keep this conversation going, and I look forward to welcoming Tom, Kristen, and Mary to another session here. Thank you so much for spending the time with us today.
Okay, yeah, perfect. Okay.
How are you?
Okay. So now you've made it. You've made it to the end of our policy meeting, and boy, do we have the right cherry on top for our conference. I have the honor of introducing the 10th awardee for the Paul Volcker Lifetime Achievement Award for economic policy. And I have just a few brief remarks to honor our honoree, Treasury Secretary Janet Yellen. We have literally been trying to give her this award for years. The last time we tried to give her this award, she told us she was going to be extremely busy as president of the American Economic Association. So we could not be more honored that you have chosen to accept the award this year. And one thing I do know is that Secretary Yellen hates it when people read off her resume. So I am definitely not going to do that. And nor do I need to in this room. So I want to just say a couple of things about Secretary Yellen. She is, for NABE, for the people in this room, a kindred spirit. Thank you. Policymakers and business economists have to make real decisions in real time based on the best data and analysis and a healthy dose of judgment. And then we have to be accountable for those decisions. And that means that we have to keep learning and keep pushing. And one thing that Secretary Yellen is an inspiration for all of us is the passion and the drive to get things right for the American people. And that is something that we can all put to work in our jobs on a daily basis. She has spoken at so many NABE events, at every incarnation in her career, many memorable speeches, 2017 Cleveland, my personal favorite. What Secretary Yellen is known for, this long resume, but I think the real gift and genius is her management style. And everybody knows she's very nice and she's very respectful, but what they don't know is what a badass she is.
I didn't know that.
She is demanding. She sees your capability better than you do. So she puts you to work, and you work harder than you've ever worked in your life. But then she listens to you. And don't we know that there's nothing better than being pushed, working hard to achieve more than you thought you could, and then feeling like you are having an impact. And the genius of this is what she benefits from is all those great ideas. And we know that when you have to make decisions in real time, You need the best ideas at your disposal, and it allows her to make good decisions.
Thank you, Jim.
So without
Thank you.
further ado,
I would like to present you. Thank you. With a Paul Volcker Lifetime Achievement Award. Thank you. Thank you. All right. Thank you, Julia. It's a pleasure to be back at NABE, and I very much appreciate your kind words, and thanks to everyone. Thank you all for this honor. I'm especially privileged to receive a Lifetime Achievement Award named for Paul Volcker, a titan in the field of economics. Paul may best be known for his work as chairman of the Federal Reserve, but his legacy extends far beyond that role. Indeed, Treasury has a special claim to him too. Paul spent nearly a decade of his career working for our department. As Undersecretary for Monetary Affairs, he shepherded our country's transition from one monetary system to another, and with it, a change in America's role in the global economy. Among the many posts in his long and varied career, Paul later called his role at Treasury the best job in the world. With apologies to my former Fed colleagues, we at Treasury take special pride in that. In the last decade of his life, Paul also left an indelible mark on the field of financial stability. Paul was an outspoken champion for stronger regulation to prevent future financial crises. He led President Obama's Economic Recovery Advisory Board, counseled the administration on key changes to the financial architecture, and advocated firmly and publicly for the banking rule that bears his name. Like Paul and many of the economists here, I am no stranger to financial crises. My career has spanned almost 2 decades at the Fed, nearly 3 years at the Council of Economic Advisors, and over 2 years now at the Treasury Department. And in that time, I've seen the US and global financial systems undergo a number of significant disruptions: the Asian financial crisis, the dot-com crash, the global financial crisis, and the COVID-19 market turmoil. I understand deeply the fear and uncertainty that these disruptions can cause, and I know well the longer-term pain these disruptions can impose on American families and businesses when they're not decisively managed. These risks were top of mind as we took forceful and immediate actions earlier this month to contain the fallout from the failures of 2 regional banking institutions. One constant across these disruptions has been a perennial debate about the proper role of government in regulating the financial sector. Waves of financial regulation have often been followed by concerted efforts at deregulation, premised on the belief that regulation is ineffective and stifles financial innovation and economic growth. I've lived through efforts like these, such as the massive pushback against the Dodd-Frank Act's enactment and implementation. And my response has always been that a stable and resilient financial system is not only compatible with responsible innovation and sustainable growth, in fact, it's a prerequisite for those goals. Our prosperity depends on the work to safeguard financial stability before a crisis occurs, just as the implementation of a strong fire code can prevent a fire from breaking out. That work mattered in 2020, when a worldwide pandemic-driven dash for cash put extraordinary strain on the financial system. A decade of focused work to improve financial stability coupled with forceful public sector interventions, helped us avoid the worst possible economic outcomes. This work also mattered earlier this month when we encountered 2 bank failures with a stronger financial system and hard-earned lessons from the global financial crisis. We have made much progress in the past 15 years, but recent events show that clearly our work is not done. During the COVID pandemic and again this month, the proverbial fire department had to be called in the form of interventions by the Fed, FDIC, and Treasury. These events remind us of the urgent need to complete unfinished business, to finalize post-crisis reforms, consider whether deregulation may have gone too far, and repair the cracks in the regulatory perimeter that the recent shocks have revealed. And we must also address new areas of risk. Since my first day at Treasury, I have made it a major priority to restore and strengthen our financial stability apparatus. My remarks today will outline the importance of this work to the American economy. I will establish why financial stability matters to American families before turning to how our financial system has performed through its most serious tests since the global financial crisis. Then I'll speak about the progress we've made on our financial stability agenda and the road ahead. First, let's start with a fundamental question. Why care about financial stability in the first place? Simply put, we care about financial stability because families and businesses benefit from a well-functioning financial system. And conversely, they bear the costs of its failures. When the financial system works, it can be a powerful engine for economic growth. Financial institutions provide credit that enables families to afford homes, invest in education, and otherwise improve their standards of living. Borrowing helps business owners form new ventures and expand existing ones, leading to innovation and job creation. The financial system also gives families and businesses safe places to save, invest, and transact. On a broader level, it helps us efficiently allocate capital across the many productive uses in society. But a fragile financial system can generate deep pain for American households when it fails. The global financial crisis led to the longest recession in the post-war era. Over 8 million Americans lost their jobs. The net worth of US households fell by over $10 trillion at the lowest point in the crisis. And the long-term unemployment rate did not recover for over a decade. Jorda, Shularik, and Taylor have found that recessions following financial crises are deeper than other downturns. The recoveries are slower too. One study put the price tag of lost output following the global financial crisis at nearly a half to a full year of US GDP. And that's the equivalent of 50,000 to 120,000 for every US household. And the pain was not evenly distributed. Families in the bottom half of the distribution lost decades of gains in household wealth, while the top lost little. Studies show that weak financial systems can amplify business cycles. In a seminal 1999 paper, Bernanke, Gertler, and Gilchrist concluded that endogenous developments in credit markets can serve as a financial accelerator. That is, they can turn relatively small shocks into large fluctuations in aggregate economic activity, including more severe economic downturns. Nellie Lang, our Undersecretary for Domestic Finance, has produced with other scholars a helpful analytical approach called growth at risk. They conclude that loose financial conditions may support economic growth in the near term, but that comes at the expense of increased downside risks in the medium term if loose conditions are accompanied by rapid credit growth. The United States has an extensive history of federal financial regulation, one that dates back to the Civil War. Through much of the 20th century, regulators primarily focused on the safety and soundness of banks, along with investor protection and market integrity. But the global financial crisis made clear that this focus was too narrow. Today's financial system is characterized by increased complexity and interconnection across market actors and geographic boundaries. A single point of failure can cascade through the system like a wildfire, leading to a failure of the financial system to perform its core functions. In the aftermath of the global financial crisis, the United States and many countries pursued new macro-prudential policies designed to mitigate systemic risk. Our goal as policymakers is to build a financial system that can provide core financial services in both good and bad times. Macro-prudential policy is not aimed at preventing external shocks, nor eliminating all volatility in the financial system. Rather, macro-prudential policy aims to make the financial system more resilient to external shocks, so the system can dampen, not amplify, their consequences for American households and businesses. We also aim to prevent the financial system itself from becoming a source of shocks, like it was in 2008. These policies are possible because financial crises share common elements with one another. And let's take the basic concept of fire sales. As described by Schleifer and Vishney, a fire sale is the forced sale of assets at a price below fundamental values. Building on this idea, Brunnermeier and Peterson show how a negative shock to the net worth of collateralized borrowers can trigger a vicious cycle of forced asset sales. The resulting price declines trigger further forced sales. At each stage, the net worth of leveraged investors falls, requiring additional liquidations. Of course, the concept of a fire sale is broader than the specific mechanism embodied in the Schleifer-Vishney or Brunnermeier-Peterson models. Just as the original spark for a real fire can come from many sources, the trigger for systemic stress is often difficult to predict. But there are common vulnerabilities and transmission channels through which financial fires can get out of hand. Excessive leverage, especially when paired with maturity and liquidity mismatches, can increase the risk that fires spread out of control. Information asymmetries can also lead to runs that have the potential to accelerate and deepen asset fire sales. This dynamic was highlighted in the research that won Diamond and Dybvig the Nobel Prize with Bernanke last year. And earlier this month, we saw one example of how dangerous these sorts of runs can be as customers withdrew deposits from Silicon Valley Bank and Signature Bank en masse. The fire analogy should make the fundamental rationale for macroprudential financial regulation intuitively clear. Due to the externalities created by fires that can rage out of control, every community has both fire codes and fire departments. Fire departments are there to extinguish fires, but importantly, fire codes are there to prevent fires from starting and spreading in the first place. The global financial crisis delivered a grave warning to the world about the risk of financial fires, so we acted. In the United States, Congress passed stricter fire codes in the form of stronger standards for systemically important banks, financial market utilities, and other firms. These reforms were designed to reduce their probability of failure and force them to internalize the cost of spillovers. Congress also created fire breaks between certain large firms and their neighbors, requiring them to plan for their own recovery and resolution. New smoke alarms were affixed to the financial system through the creation of the Office of Financial Research at the Treasury Department. That office was tasked with collecting financial data to help identify potential risks. And of course, there was a new fire marshal in town. Congress established the Financial Stability Oversight Council, or FSOC, to coordinate among agencies to identify and respond to emerging threats to US financial stability. We also knew that financial risks rarely respect national borders. In the years following the crisis, we built up the Financial Stability Board in partnership with other G20 members. We improved communication and coordination for stronger standards for financial stability policy, while also creating robust networks for responding to future crises. Since then, our financial system has gone through a number of tests. The biggest test came in March 2020, just shy of a decade after the passage of Dodd-Frank. As the coronavirus spread rapidly across the world and governments issued stay-at-home orders, economic uncertainty and financial panic set in. What followed were historic sell-offs in a broad range of financial assets, from equities to corporate and municipal bonds. Treasury yields rose as investors sought cash in this highly uncertain moment. The S&P 500 painted a clear picture of the panic. It tripped 3 circuit breakers in the span of a week as the stock market recorded historic drops. Over the past year, the financial system has gone through additional tests as financial conditions have tightened. Earlier this month, Silicon Valley Bank failed to adequately account for interest rate risks and suffered a run accelerated by the bank's outsized vulnerabilities. Its failure, along with that of Signature Bank, created a serious risk for contagious runs at other banks. It's notable that neither of these events triggered the worst-case scenario, a financial meltdown like we saw in 2007 and 2008. In large part, this was due to the post-crisis reforms we put in place. But in both cases, the government had to deliver substantial interventions to ease the pressure on certain parts of the financial system. And this means that more work must be done. Let me begin with the banking system. During the March 2020 panic, banks served as an important pillar of strength for the financial system. Large banks were better capitalized and more liquid than they were in 2007. Dodd-Frank imposed significant reforms designed to ensure these institutions could better absorb losses and meet customer demands for credit and cash. But the failures of 2 regional banks this month demonstrate that our business is unfinished. To be clear, the banking system is significantly stronger than it was heading into the global financial crisis. This is perhaps best illustrated by the fact that we've seen relative stability in the overall banking sector this month, even as concerns grew about specific institutions. Still, anytime a bank fails, it's a cause for serious concern. Regulatory requirements have been loosened in recent years, and I believe it's appropriate to assess the impact of these deregulatory decisions and take any necessary actions in response. We must also address vulnerabilities in the non-bank sector. Some non-banks, or shadow banks, consist of financial companies that carry out traditional banking functions, but are outside of or only loosely linked to depository institutions. They've grown substantially in the past few decades. In the United States, credit provided by non-banks, measured relative to GDP, has more than doubled from 1985 to today, while the same measure has remained relatively flat for banks. In many sectors, non-banks have increased competition, fostered innovation, and broadened access to credit. But in March 2020, non-banks and others pulled back from important credit markets. Extraordinary intervention by the government was necessary to stabilize these distressed markets and maintain a sufficient flow of credit to households and businesses. Put simply, the COVID shock reaffirmed the significance of structural vulnerabilities in non-banks. Now our duty as policymakers is to respond. When the President and I took office in January 2021, we inherited a financial stability apparatus at Treasury that had been decimated. For example, I walked in to find an FSOC team that was less than 1/3 of the size it was 5 years prior. In 2016, FSOC's policy, analysis, and operations teams were fully staffed. By 2021, the analysis team had been eliminated. This team, working with financial regulators, was responsible for helping to monitor systemic risk. This meant we went into the pandemic crisis without the staffing we needed to monitor risk to the health of the financial system. Over the past 2 years, I've made it a top priority to rebuild the financial stability infrastructure of Treasury. We have doubled the size of our FSOC staff with plans to accelerate hiring in the coming months. Importantly, we have recommitted to our partnership with regulators to make progress on our financial stability agenda. Let me start with our work on the banking system before turning to non-banks. Federal regulators are in the process of reviewing events surrounding the failure of Silicon Valley Bank. It's important that I don't prejudge the conclusions of their inquiry, so let me focus instead on our response to the situation that we encountered. Earlier this month, we learned about a situation at Silicon Valley Bank that required immediate action. The institution was experiencing a classic Diamond Dybvig bank run, fueled by uncertainty about the value of its assets. This run was accelerated by unique features of SVB's deposit base. The bank's depositors were highly correlated, and an unusually high share of its deposits was uninsured. Withdrawals were occurring at remarkable speed. Faced with this run, the federal government took decisive action to restore and strengthen public confidence in the US banking system. Treasury worked with the Fed and FDIC to protect depositors in the resolution of SVB. We also took the same action for Signature Bank, another institution that faced a run at around the same time. And this meant that all customers at SVB and Signature Bank received access to their insured and uninsured deposits almost immediately. To be clear, the steps we took were not focused on aiding specific banks or customers. Our intervention was necessary to mitigate systemic risks and protect the broader US banking system. We also took these actions without protecting the bank's investors or managers. In addition to these specific actions, the Fed established a new lending facility to provide additional liquidity to the banking system. Today, the US banking system is sound, even as it has come under pressure. The new Fed facility and discount window lending are working as intended to help banks meet the needs of all their depositors. The capital and liquidity positions of the overall system remain at strong levels. And as we continue to monitor conditions, let me be clear, this month's developments have been very different than those of the global financial crisis. Back then, many financial institutions came under stress due to their holdings of subprime assets, and we do not see that type of situation in the banking system today. Even in a well-regulated system, public confidence is key. When there are cracks in confidence in the banking system, the government must act immediately, and this includes making forceful interventions like we did. As I've said, we've used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we have taken ensure that Americans' deposits are safe, and we would be prepared to take additional actions if warranted. It's also important that we re-examine whether our current supervisory and regulatory regimes are adequate for the risks that banks face today, and we must act to address these risks if necessary. Regulation imposes costs on firms, just like fire codes do for property owners, but the costs of proper regulation pale in comparison to the tragic costs of financial crises. Our administration is committed to making sure that the US banking system remains the strongest and safest in the world. As we consider next steps, it's vital that we ensure the health and competitiveness of our vibrant community and regional banking institutions. The American economy benefits enormously from our broad and diverse banking system. As we strengthen the banking sector, we're also making progress on one of FSOC's top priorities, mitigating vulnerabilities in non-bank financial intermediation. Many of these non-bank institutions engage in liquidity and maturity transformation. They profit from issuing short-term obligations while investing in riskier and longer-term assets. But they're generally not regulated to account for spillovers to the rest of the financial system during times of extreme stress. There are two guiding principles in our work on non-banks. First, policymakers should address risks regardless of where they emanate from. Substance is more important than form. Similar activities that create comparable financial stability risks should be subject to comparable regulatory scrutiny. Second, policymakers should adapt and tailor policies to fit the unique structural features of the institutions and markets they're regulating. For example, systemic liquidity risks should be addressed wherever they exist, but specific policy responses should differ depending on the specific activity involved. These principles prevent risks from shifting around in the financial system in response to regulation. They enable us to address risks wherever they're found. We have pursued work on non-banks that are both inside and outside the traditional financial system. So first, let me speak on non-banks inside the traditional system. And if there's any place where the vulnerabilities of the system to runs and fire sales have been clear-cut, it is money market funds. These funds are widely used by retail and institutional investors for cash management. They provide a close substitute for bank deposits. Before the post-crisis reforms implemented by the SEC, all money market funds were generally expected to maintain a fixed $1 net asset value per share. The stable NAV was normally achievable because funds were generally limited to investments that were considered to be low risk. These funds were allowed to round their share prices to $1 when the market value of their investments fell, as long as it stayed above a certain level. But a fund had to respond if the market value fell below that level, that is, if it broke the buck. And in that case, these funds would have to reprice, and they might cease withdrawals and liquidate their assets. And this created an incentive for a run in times of extreme stress. The first redeemers could exit the fund at $1 per share, but those who waited might be subject to reduced market value as they're left with claims on less liquid assets. This created a first mover advantage, an incentive for investors to redeem at the whiff of a problem. During the global financial crisis, anticipated losses on Lehman Brothers commercial paper led to a run on the $62 billion reserve primary fund, the oldest money market fund in the nation. Concerns about Lehman then sparked concerns about commercial paper issued by other banks, and this led to runs on other money market funds. A post-mortem report revealed that as many as 28 other funds had NAVs low enough for them to also break the buck. Even without a fixed NAV, liquidity mismatch in other kinds of funds can still make them vulnerable to runs and fire sales. Open-end funds offer daily redemptions, but some hold assets that cannot be sold quickly, particularly in large volumes. Like money market funds, this liquidity mismatch does not typically pose problems in normal times when flows to and from funds are not outsized. But in times of market stress, shareholders are incentivized to redeem early before fire sales of the liquid assets lower the value of their holdings. Driven by this dynamic amid the pandemic shock, a record $255 billion flowed out of bond mutual funds in March 2020. The structural vulnerabilities at the heart of money market and open-end funds aren't new. In the banking sector, capital and liquidity requirements and federal deposit insurance reduce the likelihood of runs taking place. In case runs occur, access to the discount window helps provide buffers for banks. Yet the financial stability risks posed by money market and open-end funds have not been sufficiently addressed. Over the past 2 years, the SEC has proposed rules to mitigate the vulnerabilities plaguing these funds. The SEC's proposals would reduce the first mover advantage, reducing run incentives during times of stress. They would also require new liquidity management tools while mandating more comprehensive and timely information on these funds for the SEC and investors. Abroad, Treasury has worked with the FSB to advance international commitments that enhance the resilience of money market funds. We will soon review the implementation and later the effectiveness of reforms taken by member jurisdictions. Treasury is also working diligently in the FSB to revise recommendations on liquidity management in open-end funds to bolster their resilience. We've also been focused on mitigating systemic risks from the use of leverage at hedge funds and other similar funds. The hedge fund industry has expanded significantly over the last 5 years. In 2021, gross assets reached almost $10 trillion, up more than 50% since 2016. Hedge funds are also playing a more prominent role in markets that lie at the core of the financial system, like the US Treasury market. Overall use of leverage among hedge funds is fairly small on average, but leverage appears to be concentrated among a select number of large hedge funds. 25 funds account for around half of all hedge fund borrowing and derivatives exposures. Further, funds with certain strategies are engaged in very significant use of leverage. Now, leverage can support economic growth, but excessive leverage is dangerous. It can add fuel to fire sales by triggering a negative spiral of margin calls and rapid asset liquidations. These fire sales can transmit stress to hedge fund counterparties and other market participants, including large systemic banks. Post-crisis banking regulations have helped reduce the potential of spillovers to the banking system. But spillovers from these fire sales to other market participants remain a risk. In March 2020, these risks became reality. For example, hedge funds were among the top 3 sellers of Treasury securities that month. FSOC has determined that they materially contributed to Treasury market dysfunction. We've taken a number of actions to address financial stability risks due to leverage. First, we restored FSOC's hedge fund working group, which had previously been disbanded. No single regulator has the authority or information to comprehensively assess the risks posed by hedge funds, so the working group has developed a risk monitoring framework to identify hedge fund-related risks to the financial system. The framework is based on data from the SEC's Form PF, which was initiated after the financial crisis, as well as supervisory information from relevant agencies. This group reports regularly to FSOC and will develop policy recommendations if it's determined that leverage or other vulnerabilities are significantly increasing financial stability risks. Second, Treasury's Office of Financial Research will continue to enhance data collection on bilateral repo transactions without a central counterparty. These are a key source of leverage for hedge funds. This collection will also help to close a large remaining gap for Treasury market data. And it will be important for Treasury's broader efforts to advance reforms with financial regulators that improve the resilience of the Treasury market, which has seen some episodes of stress in recent years. A comprehensive financial stability program must also limit vulnerabilities from non-traditional financial products. New technologies have the potential to provide faster, safer, and cheaper financial services. They can also foster greater financial inclusion. But as we've learned from history, innovation without adequate regulation can result in significant disruptions and harm. Over the past decade, the digital assets ecosystem has grown significantly in scope and scale. It's also been subject to significant shocks and volatility. In November 2021, global market capitalization reached approximately $3 trillion. Just over half a year later, it lost 2/3 of its value and has not markedly recovered since then. We've been vigilant in monitoring the potential systemic risks of digital assets since before the collapse of FTX and other platforms. In 2021, the President's Working Group on Financial Markets issued recommendations for stablecoin regulation. And last year, Treasury and other agencies released a series of reports on digital assets policy in response to an executive order by President Biden. Out of this effort, we identified areas of further work and coordination among the financial agency and gaps in existing authority that would require legislation. Take the example of stablecoins. Today, stablecoins are frequently used to pay for speculative crypto assets, but they could be used more widely for payments for other goods and services. After all, stablecoins are designed specifically with the goal of maintaining a stable value. Typically, that's 1-to-1 with the US dollar. The largest stablecoins seek to maintain this peg by backing the coin with a pool of reserve assets. This structure creates the same kind of run incentives that we see in the traditional financial system. Stablecoin holders often have a first mover advantage to redeem in times of stress before conditions deteriorate further. Fire sales become necessary and the value of reserve holdings fall. As we saw in 2008 and 2020, runs in fire sales can spread like a contagion. A run on one stablecoin can lead to panic runs on other stablecoins, causing even broader sell-offs. Given these parallels, we've recommended that Congress enact legislation to establish a comprehensive prudential regulatory framework for stablecoin issuers. Such a framework would include consolidated federal supervision, requirements for how a coin could be backed, capital and liquidity requirements, and restrictions on affiliation with commercial companies. In addition to stablecoins, we must identify and fill gaps in existing authority for the oversight of other crypto assets, including those identified in the FSOC Digital Assets Report. We have existing consumer and investor protection standards in traditional financial markets, and these same principles and protection should apply in markets for crypto assets. Finally, we're also working to address risks specific to digital assets. This includes risks associated with vertical integration of crypto trading platforms and lack of visibility into the operations of subsidiaries and other entities across these businesses. And we're also exploring broader policy issues around the future of money and payments, including the possibility of a central bank digital currency. Now, I'd be remiss if I did not end by speaking about one of the most important short-term actions that Congress can take to safeguard our financial stability, and that is to raise or suspend the debt limit. Since 1789, the United States has paid all of our bills on time, and it should stay that way. And my assessment, and that of economists across the board, a default on our obligations would cause an economic and financial catastrophe. No financial system is designed or regulated to be prepared for its own government to choose not to pay its bills. A breach of the debt ceiling could lead to a prolonged downturn and a global financial crisis, and it could upend the lives of millions of Americans and those around the world. This catastrophe is preventable. Congress must raise or suspend the debt limit, and it should do so without conditions and without waiting until the last minute. Well, to end, I will note that our work is not yet done. That much is clear from the events earlier this month. Financial stability is a public good. Government plays a fundamental role in the provision of financial stability, as the costs of systemic failure are externalized to the broader society. At Treasury, we take this responsibility very seriously. Today, I've touched on select areas of our work, but our financial stability efforts extend to areas from cybersecurity to climate-related financial risks. As we chart a path forward, let me reflect on the contributions of the economics profession to this endeavor. In one of his most famous passages from the General Theory, John Maynard Keynes wrote that the ideas of economists and political philosophers, both when they are right and when they are wrong, are more powerful than is commonly understood. There is perhaps no better testament to this sentiment than the emergence of the field of financial stability. Early economists who studied systemic risk informed the views of the first responders, those who remarkably stopped the financial meltdown midstream in the fall of 2008. In 2020, financial regulators in the US and around the world leaned on post-crisis reforms and intervened decisively to avoid a similar meltdown. Their work was made possible by the explosion of research in this area over the preceding decade. We should celebrate these developments as a collective contribution of our economics profession, just as the Keynesian explanation for recessions and depressions was an accomplishment of our profession in the mid-20th century. It's time to continue this work anew. My pledge to you is that I will continue to lead on the crucial work of financial stability at Treasury, and I hope you will be our partners as we continue to build a financial system that works for the American people. Thank you so much for this honor. Thank you. Thank you.
Thank you, Secretary Yellen. I know I feel better. So we are at an end of our 39th policy conference. And as you leave, know that please, you will have an evaluation form in your email box. We look at those, we improve and change our processes in response to those. This is your conference. Help us. Give us feedback, help us make it better for you. Thank you all for joining us. Thank you for sticking it out, and we'll see you at the annual meeting.